The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. It's a legislative hearing to examine a bill put forth by the Vice Chair of the Monetary Policy and Trade Subcommittee, Mr. Huizinga, to make certain reforms to the Federal Reserve System. I now recognize myself for 5 minutes to give an opening statement. When this committee first embarked on the Federal Reserve Centennial Oversight Project last year, we promised a thorough review of America's central bank. Today's hearing is this committee's 11th hearing on the Federal Reserve in the 113th Congress. Certainly our understanding of the Fed has been enriched through discussion and debate among our colleagues and complemented by the knowledge and perspective of many distinguished witnesses and scholars, including those who are here today. As the hearing schedule for the 113th Congress begins to wind down, I do wish to thank all of our colleagues and witnesses for their contribution to this project and the risk they undertook to provide such. I say risk because I'm reminded that Senator Nelson Aldrich, one of the legislators behind the Federal Reserve Act, noted that, quote, "The study of monetary questions is one of the great causes of insanity," unquote. Hopefully we can avoid that fate. Regardless, we do expect to issue a full report on our findings from the Centennial Oversight Project in the fall. Today we consider the first piece of legislation to arise from this process, legislation to begin to reinvigorate the Fed with the type of accountability to Congress and the people that the founders expected of all federal agencies when they drafted the Constitution. I again say the first piece of legislation because reforming an institution as old, entrenched, important, and as powerful as the Federal Reserve will be a work in progress. But it is work we must not ignore. There are many excellent, capable public servants at the Fed who have served our nation well and are currently serving our nation well. But I believe a critical examination of the last 100 years of the Fed's actions reveals a mixed bag at best. And most recently, we have seen a radical departure from the historic norms of monetary policy conduct, from an unprecedented use of 13(3) exigent powers to select intervention in distinct credit markets, to the facilitation of our unsustainable national debt, to a blurring of the lines between fiscal and monetary policy, all of which presents large and unwarranted risk to our economy. Clearly, our work must be thoughtful, it must be careful, and it must be deliberate, but much is at stake, so we must ignore it. Thus, I fully expect the legislative effort to continue in this Congress and the next. A reoccurring theme throughout our hearings has been that monetary policy is at its best in maintaining stable, healthy economic growth when it follows a clear, predictable rule or path, free from political micromanagement, as it did in the Great Moderation of 1987 to 2002. Earlier in her career, Chair Yellen said at an FOMC meeting that following one type of rule, specifically the Taylor rule, is, quote, "what sensible central banks do," unquote. I agree. Let me make one thing clear at the outset. We do not suggest for a moment that Congress, much less the White House or Treasury, should conduct monetary policy operations. We continue to respect the Federal Reserve's independence in monetary policy. But that independence and discretion must be paired with appropriate transparency and accountability. What we require today in this legislation is that the Fed use a clear map of its own choosing to set the course for monetary policy and share that map with the rest of us. Additionally, the case for the Federal Reserve independence, when it sets monetary policy, does not hold up when we consider the Fed's new powers under Dodd-Frank to regulate an ever-increasing share of the American economy. The Fed should not be permitted to hide its prudential regulatory actions behind its monetary policy independence cloak. So today we consider a statutory requirement, among others, that the Federal Reserve conduct cost-benefit analysis as it adopts new regulations. Even President Obama has issued 2 executive orders reaffirming the importance of thorough cost-benefit analysis by both executive and independent regulatory agencies. Today's legislation includes a number of other additional transparency and accountability provisions which are badly needed for the Federal Reserve. It is clearly time to hold the Fed to the same openness and transparency that we demand of other federal agencies. In closing, 2 final points. I want to thank Chairman Campbell and his committee for all the great work they have done and will continue to do on the Federal Centennial Oversight Project. I want to thank Chairman Garrett, whose ideas have formed the bulk of the bill that will be before us today. And I want to thank Vice Chairman Huizenga for his work on carrying this bill as well. Secondly, I want to emphasize again that I expect further pieces of legislation to follow. For example, we continue to examine the Fed's 13.3 powers as modified by Dodd-Frank. Also, many in the public have inquired about H.R. 24, the Audit the Fed bill. Counterintuitively, that bill falls under the jurisdiction of the House Oversight Committee, not our own, and we look forward to Chairman Issa bringing that bill to the floor. And I would note that today's bill contains a provision requiring the GAO to ensure that the Fed complies with our statute by auditing the monetary rule they submit to Congress, and thus complements the Audit the Fed bill. Again, our goal today is to begin the process of developing legislation that will ultimately strengthen the Federal Reserve in fulfilling its mission to maintain stable prices and job growth and ensure that the Fed's rulemaking process is transparent and predictable. I appreciate our panel today for coming to the hearing. I now yield 5 minutes to the ranking member.
Thank you very much, Mr. Chairman. Today, under the guise of reform, my colleagues on the other side of the aisle have put forth legislation that will cripple the Federal Reserve's ability to promote growth, stabilize the economy, and in times of extraordinary crisis, take decisive action to avoid an economic collapse. This legislation is a concession to the opponents of the Dodd-Frank Wall Street Reform Act by making the Fed's rulemaking more tedious, more expensive, and subject to endless legal challenges by those who do not agree with its decisions. Unfortunately, this proposal follows a Republican roadmap we have seen too often on this committee. First, find a regulator charged with holding Wall Street accountable or rooting out the risky behavior that led to the worst economic crisis in 80 years. Next, claim that regulator lacks transparency or accountability and therefore must be reformed. Finally, push legislation purported to address these issues through unnecessary obstacles like cost-benefit analysis, new rules, and GAO audits, all of which are carefully designed to gut the agency's ability to do its job. We've seen this play out with legislation impacting the Consumer Financial Protection Bureau, the Securities and Exchange Commission, and the Commodities Futures Trading Commission, cops on the beat that protect average Americans and our economy from bad actors in the financial system. Today, Republicans take aim at the Federal Reserve, which played an integral role in stabilizing the economy at a time of intense crisis, and which has continued to play an essential role in growing our economy and promoting full employment. When the crisis hit, the Federal Reserve challenged conventional thinking on the limits of monetary policy and appropriately took quick and decisive action that kept our nation from slipping into a depression. But the legislation we consider today seeks to prevent the Federal Reserve from taking such innovative action in the future, creating rules that would prescribe monetary policy based on a rigid set of circumstances and factors, ignoring the best judgment of experts. Mr. Chairman, the Fed's Federal Open Markets Committee contains many of the nation's most respected economists from across the nation. Its governors of the board are subject to democratic accountability through the process of Senate confirmation, and the overwhelming majority were confirmed by the Senate with bipartisan support. But this legislation would discount the experience, judgment, and discretion of these experts, instead putting decisions related to inflation and employment on autopilot based on a set of abstract factors. If the Federal Open Markets Committee did deviate from the rule, the legislation requires the Government Accountability Office to conduct a costly and time-consuming audit, one that would undermine the independence of the Fed, shake public confidence in its decision-making, and create unnecessary uncertainty in monetary policy. Such a process needlessly politicizes the Fed's decision-making process, compromises its role as a pillar of the global financial system, and ironically creates more market volatility, not less. Recently, Donald Kahn, 40-year veteran of the Fed, formerly vice chairman and George W. Bush appointee, expressed his concern with this approach, stating, quote, "I don't think this is a good idea. I'm highly skeptical that adhering to preconceived rule will be appropriate to achieving the Fed's objectives under many circumstances," quote unquote. In addition, this legislation brings back the time-honored Republican tactic of cost-benefit analysis, imposing heavy administrative hurdles and new litigation risk that will significantly impair the Fed's ability to do its job in a timely manner. Like efforts with other regulators, this provision allows Wall Street to tie up the Fed's rulemaking in endless litigation, draining resources and impeding its ability to guard against risk to our financial system. Mr. Chairman, this legislation does nothing to promote economic growth, create jobs, or ensure a more stable financial system. In fact, it enshrines a regulatory policy that lets bad actors run amok, while regulators waste time dithering with audits and frivolous lawsuits. And it does so at a time when post-Dodd-Frank, we've asked and need the Fed to do more than ever before. I thank you, and I look forward to the witness's testimony, and I yield back the balance of my time.
Chair now recognizes the gentleman from Michigan, Mr. Huizinga, the Vice Chairman of our Monetary Policy and Trade Subcommittee and co-author of the legislation before us, for a minute and a half.
Thank you, Mr. Chairman. And this is a special day, not because we're just talking about this piece of legislation, but because I get to share it with a family member. And sorry, buddy, this is what dads live for, embarrassing their kids. My oldest son, Garrett, is here with us today, and I'm thrilled that we could have him here. And that's okay.
Without objection, add another 10 seconds to the gentleman's time.
Thank you, Mr. Chairman. And Garrett, don't worry about it. There's a lot of other people that are going to be hanging on, trying to follow all this as well, because it is very complicated. But I appreciate this hearing today, because over the past several years, the Federal Reserve has gained unprecedented power, influence, and control over the financial system while remaining shrouded in mystery to the American people. The standard operating procedure cannot continue. We must lift this veil of secrecy and ensure that the Fed is accountable to the people's representatives. That's why, along with Capital Markets Subcommittee Chairman Scott Garrett and my own Chairman, Chairman Campbell, introduced H.R. 5018, the Federal Reserve Accountability and Transparency Act, pulling back the curtain of the Fed by increasing accountability and transparency by limiting Fed officials' blackout periods to discuss policy with Congress, opening the rulemaking process, and requiring the Fed to provide a low-cost benefit analysis for every regulation that it issues. Additionally, this legislation urges the Fed to adopt a rules-based approach to monetary policy, as Dr. Taylor had talked about for a number of times, instead of the continued improvisation strategy currently being employed. Should the Fed fail to adopt a rules-based approach, it would then trigger an audit of the Fed's books. I think it's important to note that our bill is complementary to H.R. 24, which is before the Oversight Committee, the Federal Reserve Transparency Act, introduced by our colleague Paul Brown, who I'm a co-sponsor of. But, Mr. Chairman, again, I appreciate the you calling attention to this important issue, and I'm looking forward to hearing comments from the distinguished panel on my legislation to rein in the Federal Reserve. And with that, I yield back.
Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee, for 2.5 minutes.
I thank the Chairman and all the panelists. Oversight of the Federal Reserve is important, but the Federal Reserve Accountability and Transparency Act goes far beyond oversight. It attempts to blatantly influence the Fed's monetary policy, undermining the independence that economists believe is vital to a central bank's success. This bill also goes far beyond the, quote, audit the Fed bill that this House voted on last Congress. As one newspaper described it, it is audit the Fed on steroids. Under this bill, every time the Fed deviated from the Republicans' desired monetary policy formula, the Fed chair would be hauled up in front of Congress to explain herself. And even more troubling, the Fed would be subject to a GAO audit and report of the monetary policy decisions, with Congress setting the parameters of what the audit would be. As the previous Fed Chairman Ben Bernanke said, allowing the GAO to audit the Fed's monetary policy decisions would create a chilling effect and, I quote, would prevent the Fed from operating on the apolitical, independent basis that experience shows has been so successful in lowering inflation and a strong economy for our country. I would like to place in the record his statement before this committee on the prior bill on audit the Fed. This goes far beyond that, but he explains the chilling, terrible effect it would have on the independence and the ability of the Fed to make economic decisions that are separate from politics but are good for the overall economy of this country. We need the Fed's independence is very important and crucial. Its credibility with the markets as an independent operator that is committed to achieving the goals of price stability, regardless of political consequences, would be compromised. So while it's true that this bill doesn't force by law the Fed to follow a particular formula for interest rates, it does attempt to bully the Fed into following the Republicans' preferred monetary policy. This inappropriately interferes with the Fed's independence on monetary policy matters, and I find it deeply, deeply troubling. I yield back.
Chair now recognizes the gentleman from New Jersey, Mr. Garrett, the chairman of our Capital Markets Subcommittee, co-author of the legislation before us, for a minute and a half.
And thank you. And I begin by thanking the chairman for holding this hearing to consider the legislation to reform the Federal Reserve as it passes its 100-year anniversary. I also want to thank the witnesses for appearing before the committee as well. I would also like to recognize the gentleman from Michigan, Vice Chairman of the Monetary Policy and Trade Subcommittee, for taking the lead and working on this legislation to reform the Federal Reserve. And I thank you very much for taking that effort. As the Fed passes its centennial mark, Dodd-Frank will soon mark its own 4-year anniversary. It is timely that this committee is currently considering how the Fed and Dodd-Frank has transformed our financial regulatory environment, and I would submit that an already muscular Federal Reserve, bolstered by a 3,000-page financial reform law, has resulted in a central bank that is like on steroids. Since Dodd-Frank's passage, the Fed has adopted a new mission of ensuring financial stability and serving as a macro-prudential regulator over our nation's entire financial system. And while some raise a question about the appropriateness of granting such vast authority to a singular regulatory body, especially an authority charged with the conduct of monetary policy, everyone should agree that the great power must be accompanied by robust oversight. Unfortunately, there has not been a corresponding increase of much-needed transparency at the Fed. The Fed's regulatory activities have taken place behind a fraternity-like veil of secrecy, obstructing openness and preventing proper accountability. For this reason, today we will consider legislation that would take a step forward to establishing an appropriate level of transparency, considering the bank's monetary, prudential, and supervisory functions. In particular, the FRAD Act would require the Fed to increase its responsiveness to Congress, increase the transparency of its regulatory activities, and foster accountability in its international negotiations. And I would just add, Mr. Chairman, that in light of the fact that the Fed Chairman Yellen testified before the committee back in February, it has taken 4 months for her to respond to us, as we have just now received her responses at this period of time.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Ohio, Ms. Beatty, for 2 minutes.
Thank you, Mr. Chairman and Ranking Member, and thank you to our witnesses. In addition to the comments, Mr. Chairman, that my colleagues have made in their opening statements, I must add that I'm a little disappointed this morning as I sit here wondering why we aren't working to improve our nation's economy rather than trying to find ways to hamstring the primary regulator responsible for overseeing the operations of our nation's financial markets. While I always welcome witnesses, I'm disappointed that we continue to hold hearings on issues which are not at all time-sensitive to this committee. For example, with only 23 legislative days before the expiration of the Export-Import Bank, it seems a little short-sighted to hold a legislative hearing on a bill to reform one of the most effective agencies in the federal government when what we should be doing is having and holding legislative hearings on H.R. 4950, a bill to reauthorize the Export-Import Bank, which would protect and create American jobs, help lower Americans' trade deficit, and importantly for my conservative colleagues, reduce the federal deficit. I therefore encourage the chairman to strive to advance consensus-built legislation that can drive forward economic growth in a meaningful, policy-oriented way that helps, not harms, our nation. Thank you, and I yield back.
Chair now recognizes the gentlelady from Minnesota, Ms. Bachman, for 1 minute.
Thank you, Mr. Chair. Tragically, the Federal Reserve's policies have facilitated deficit spending, encouraged the accumulation of $17.6 trillion in national debt, caused market volatility, failed to reinvigorate the sluggish American economy, and will cause inflation that will harm American families and businesses. Fortunately, our colleagues, Mr. Huizenga and Mr. Garrett, have introduced bills to encourage the Fed to use a rules-based monetary policy, opening the Fed's decisions on international regulatory negotiations to public comment, bringing transparency to the Dodd-Frank stress test, clarifying the Federal Open Market Committee blackout period, and requiring cost-benefit analysis for all Fed regulations. I'm pleased to co-sponsor these bills. The Audit the Fed bill will provide Congress with necessary tools to provide additional oversight to the Fed's ever-growing powers. It is high time and a long overdue to pass these bills and get this done. I congratulate my colleagues on getting this done, and I yield back.
Chair now recognizes the gentleman from Indiana, Mr. Stutzman, for 1 minute.
Thank you, Mr. Chairman, and thank you also to our witnesses today. Mr. Chairman, you and I and our House Republican colleagues have a long history of pushing tax and regulatory relief for families and small businesses. We do so in pursuit of long-term economic growth, but also in the pursuit of fairness. The question is whether monetary policy reflects our goals. The Fed's massive and growing impact on everyday Americans' lives and its $4 trillion balance sheet is at least as impactful as tax and regulatory policy. Consider that the typical legislation in front of Congress is judged by a score from the CBO. The Fed, on the other hand, regularly weighs policies that can be judged by their impact on GDP. It is critical that we preserve Americans' confidence in the objectivity of their central bank for the 21st century and beyond. That is why the Fed must adopt a rules-based approach to monetary policy and focus on the long term. I look forward to today's discussion and again thank the Chairman for calling this hearing. I yield back.
We will now turn to our panel of witnesses, each of whom I believe has testified before this committee in the past, so I will provide very brief introductions. First, we welcome Professor John Taylor, the Mary and Robert Raymond Professor of Economics at Stanford University and author of The Taylor Rule. Next, we will welcome Dr. Mark Calabria, the Director of Financial Regulation Studies at the Cato Institute. Next, Ms. Hester Peirce is the Senior Research Fellow at the Mercatus Center at George Mason University. Finally, we welcome Professor Simon Johnson, Professor of Economics at MIT. Without objection, each of your written statements will be made a part of the record after your oral remarks. Again, since I think you have testified before, you well appreciate our lighting system. Dr. Taylor, you are now recognized for your testimony.
Thank you very much, Mr. Chairman, Ranking Member Waters, other members of the committee for inviting me to testify. I would like to compliment Congressman Huizenga for bringing his son to this hearing. I always like to bring family members to my classes at Stanford. It really helps illustrate things. I was thinking of bringing my grandchildren. today, but they're only 5 and 3. But to tell you the truth, it's the future we're talking about here, so it's very important. I want to focus my remarks on Section 2 of the Act, which is the requirements for policy rules for the FOMC. Many people, for many years, have shown that when monetary policy is conducted in a rule-like way, economic performance is better. There's price stability, unemployment comes down, growth is stronger, and productivity growth is stronger. That research is continuing. Just a few weeks ago, it was a conference at Stanford where a whole slew of experts, some currently on the Federal Open Market Committee, spoke in favor of a rules-based policy because they know, they've seen it works better. And there's experience that shows that. As Chairman Hensley was mentioning, when policy has been rules-based, the economy has performed well, and the example of that is the 80s and 90s until recently. When it's not been rules-based, the economy has floundered, and we've had higher unemployment. In the 1970s are an example of that, and quite frankly, roughly the last decade is another example. So the stakes are huge. I don't think this should be a partisan issue in any way. Central bank independence is very important, but it doesn't seem to have been enough to prevent these swings towards more interventionist discretionary policy compared to rules-based policy. So that's why I think that some legislation that goes beyond central bank independence is important. And that's why I welcome especially Section 2 of this Act. It would simply require that the Federal Reserve stipulate its policy rule or its strategy for setting instruments of policy. The Congress would not tell the Federal Reserve what policies to follow. That's the job of the Federal Reserve. The Congress, of course, has responsibility of oversight. And so the idea of this legislation is when the Fed deviated from its own rule, it would be required to explain why. It seems to be the essence of transparency and accountability. How could someone object to that? I think the legislation is quite well balanced, well crafted, well designed. It definitely takes into account all the research I know about. And I've been doing this for 40 years, as you can tell by the color of my hair. I think it reflects the fact there's differences of opinion of how monetary policy works. But in that context, it puts limits on the degree of excessive intervention that takes place in, I think, a transparent and accountable way. It certainly allows enough flexibility for the Federal Reserve to react during a panic like in 2008, the way they did. There is nothing in here that restricts the Federal Reserve's lender of last resort responsibilities. Don't let people tell you that. It also provides flexibility in the sense the instruments of the Fed don't have to be fixed. They move around, but they do it in a predictable, understandable, rule-like fashion. Moreover, the legislation is written in a way that if the Fed finds itself in a predicament because the world has changed or there's a special event, it can actually deviate from its own rule as long as it explains why to the Congress and to the American people. It just seems so reasonable to require that. The legislation builds on experience of previous attempts to requiring the Fed to report. Actions that were removed from the Federal Reserve Act in 2000 essentially replaces them. So I think it provides the appropriate degree of congressional oversight without in any way restricting the independence of the Federal Reserve. Of course, some will object. I've already heard some of the objections right here. But if you look at the transcripts of the Fed, if you look at the speeches of Federal Reserve members, if you look at what they've written, there's almost universal support for the concept of a rules-based policy. It's hard to find exceptions to that. Of course, they will say, well, maybe not now. We're not quite ready. But that's a difference of timing, really not a difference of whether we should do it or not. I believe the Fed could really improve this legislation if it had constructive comments to make. But even as it exists now, I believe this legislation could be made to work by the Fed. it would improve economic performance, and they would make it work. Thank you, Mr. Chairman.
Dr. Calabria, you are now recognized for a summary of your testimony.
Thank you. Chairman Henschel, Ranking Member Waters, distinguished members of the committee, it's a pleasure to be back here. I hope I haven't started to wear out my welcome yet. Let me first say that neither Cato nor I actually endorse specific pieces of legislation, but with that in mind, I do think the general principles behind the Act are laudable. I'm going to try to touch on each section, but I'm going to just quickly say about Section 2. You know, Professor Taylor has literally written the book on the topic. There's not really a lot I could add. I will just say that I will associate my remarks and very much support pretty much 95% of what he said in Section 2. So with that, let me go to the other sections very quickly. I think Sections 3 changes on the blackout period are very reasonable. Certainly would help Congress do its oversight in terms of non-monetary policy. Let me say that Section 4 that covers the stress tests, I am worried because since the stress tests are becoming such a core of bank prudential regulation that they deserve scrutiny. I think they have repeatedly rested upon questionable assumptions. I'd go as far to say that I don't actually think they've been all that stressful. And so I do think they need more transparency. I'm worried they're becoming a substitute for sound risk management and regulation rather than a complement. More importantly, I'm worried that the stress tests are encouraging greater uniformity across bank balance sheets. We saw this with the Basel Capital Accords, where they nudged banks into herding into similar assets, such as mortgage-backed securities and sovereign debt. Now, when everybody, that is all banks, hold the same assets, then nobody's really a buyer when everybody wants to be a seller. I worry that this contributes to fire sales and can cause actually shocks that would not be systemic to become systemic. So I'm very concerned about the direction of the stress tests. In my opinion, a robust financial system would be one with a greater diversity of asset holdings, business models, and funding sources. I would prefer that the Federal Reserve reduce its reliance on stress tests and instead focus on simple, verifiable measures of bank safety, such as actual unweighted levels of common equity that actually can absorb loss. I will note as an aside, we were doing stress tests for Fannie and Freddie long before we were doing them for banks, and we saw how well that turned out. Let me quickly say on Section 5, the shift from a minimum 2-year appearance by the Federal Reserve to a quarterly appearance, I think would really help improve communications between this committee and the Federal Reserve. Particularly, I think it would help a lot of junior members. Obviously, the chair and ranking member have a tremendous amount of access, maybe not as much as they'd like, but a tremendous amount of access with the Federal Reserve chair. That does not hold true for members across the committee. So I think having the Fed up here, and it's certainly worth saying that the Fed chair is usually up here about 4 times a year anyhow. The additional reporting requirements in Section 6 to me are fairly reasonable and welcomed, certainly on the rulemaking side. One of the things that's gotten the most controversy is Section 7's requirement for cost-benefit analysis. I feel that this would nudge the Fed to be more explicit about the assumptions that go into rules, which would encourage us to have clearer thinking about the impact of those rules. Now, of course, that some would object that subjecting the Fed the cost-benefit analysis would stifle the regulatory process. I will note if you go back and look at the legislative history in the 40s of the Administrative Procedure Act, the same things were said about notice and comment, that if you had to put rules out for notice and comment and public input, that would slow the process. Obviously, it does slow the process. It takes a minimum of almost a year to really do a rulemaking seriously. But I think our objective should be not speed, but quality. And just as notice and comment has improved the regulatory process, I believe cost-benefit analysis would improve the regulatory process. I certainly, however, don't see it as a panacea. One of the things that I want to emphasize that I actually think hasn't got much discussion, but I actually think is one of the more important parts of the bill, is Section 8 of the bill allows individual Fed board members to have their own staff. This is the case at the SEC. This is the case at the CFTC. The Fed board members are far too dependent on the chair. They're far too dependent on the Fed staff. I would ask the members to imagine what their lives would be like if they had no staff and they were dependent on the staff of the chairman of the committee. As much as I'm fond of this chairman's staff, you know that you would be at a disadvantage. The members of the Fed board are the same thing. So again, this is a very small thing, but I think it actually have a very big impact in the long run. Let me also emphasize, while several provisions of the bill address transparency in Federal Reserve rulemaking in the area of financial regulation, I believe our ultimate objective should be to get the Fed out of financial regulation, To me, that would increase the independence of monetary policy, but just as importantly, and I think it's beyond dispute, the Fed has a lousy record at financial regulation. Despite its own problems, I would rather transfer those responsibilities to the FDIC. They've had their own problems, certainly, but I think they do a far better job at it. I will also note that I have a few suggestions for qualifications, Fed board members, in my written testimony, which I believe would increase the Federal Reserve's independence and reduce the degree of groupthink that so dominates the boards most of the time. I also want to end with saying a lot of the conversations are about independence from Congress. I think the far more pressing concern in my mind is that we've got to increase the degree, and this is not a partisan thing, I want the Fed to be independent of every executive branch president. We all know the history of Arthur Burns and the Nixon administration. They were far too close by any measure. I think this Fed and I think previous Feds have acted as adjuncts of the executive branch, and I find that far more problematic than any insights and any influences that this body might have. Thank you.
Ms. Peirce, you are now recognized for a summary of your testimony.
Chairman Hensarling, Ranking Member Waters, and members of the committee, thank you for the opportunity to be here today. I'll focus my remarks on regulatory as opposed to monetary policy. Regulatory and supervisory practice are areas where the Fed does need greater transparency, accountability, and more rigor in their processes. Before we look at these issues, we should think about some basic questions. Do we think that the Fed should be supplanting the private market in allocating capital and in designing the financial system? And do we think that it should be doing those things behind closed doors? Dodd-Frank expanded the Fed's regulatory mandate over banks and non-banks, and the Fed has been aggressively pursuing that mandate. And as a consequence of that, the Fed has been changing the way it approaches regulation and using a macroprudential approach, which allows it to intervene in private decision-making and direct private financial institutions in a way that it thinks will enhance financial stability. But as Dr. Calabria alluded to, that sort of push from the government towards the private sector has not always worked very well in the past. And to make matters more complicated and more troubling, the Fed has a penchant for non-transparency. And what that means is that it's making these major decisions without the input from outside the Fed that might say you're making a mistake or you're taking an action that might actually be destabilizing the financial system. We can take steps to improve the situation. One would be to enhance the Fed's accountability to Congress, and that could be done by having the Fed chairman appear more frequently before Congress. Another approach is to make sure that their regulatory agenda is being made clear and transparent to Congress so that Congress knows what regulations are in the pipeline. Another step that we can take is that the Fed's rulemaking can be more rigorous, transparent, and accountable and afford more opportunities for public input. One way to do this is to have economic analysis. The Fed is an independent regulatory agency, and so unlike executive agencies, it's not subject to executive orders that require economic analysis. And so in asking the Fed to do economic analysis, what you're really asking them to do is identify the problem they're trying to solve, identify some solutions to those problems, and then do a cost-benefit analysis to figure out what the costs and benefits of each solution are. And then once you're ready to adopt a rule, you establish metrics so that you can go back several years later and see if your rule is actually working the way you intended it to work. It's important for this process to be done transparently and in the public eye so that the public can weigh in and sharpen the Fed's analysis. Public input is also important in international discussions that the Fed is having. Of course, the Fed needs to be in constant communication with its international counterparts, but there's a concern that internationally decisions are being made and then they're being imported here without an opportunity for people here to weigh in. And aside from external accountability, the Fed should have some more vigorous internal dialogue, which Dr. Calabria alluded to. I think that is very important. And one way to do that is to enable each governor to have a small staff of his own who can work on issues that are important to him and not be responsible to the chairman. The Fed's turning 100, and it is an important time for us to think about reforms. I think we need to frame those by asking some fundamental questions. Do we feel comfortable with having the Fed supplant and override private market decision-making? And if we do feel comfortable with that, what's the proper level of accountability and transparency and oversight? Thank you very much.
Dr. Johnson, you're now recognized for your testimony.
Thank you, Mr. Chairman. I'd like to emphasize 3 points that I expand on in my written testimony. First, I like a couple of the statements that you had in a recent speech. I guess it was published in the Cato Journal. First was that the Fed must maintain its independence with respect to monetary policy. And the second was the Fed must always be led by experts trained in the science of economics, including, you mentioned, the Austrian and Chicago schools of economics. I know quite a few of these people, and they certainly have plenty of that training. I think those are laudable and exactly the right goalpost to set. I think there's a tension, Mr. Chairman, between those goals and what you have in this legislation. As Professor Taylor has said, and as he's established, he and many colleagues have established with a lot of research, we want to have, there are some advantages to rules with regard to monetary policy, particularly the predictability that you hope the central bank will bring to the economy and bring to its communications. And central banks have moved a great deal in the direction that Mr. Taylor and others have urged over recent decades. But what you have in this legislation is not going to make things predictable. This is worse than monetary policy by Congress. This is monetary policy by some sort of Spanish Inquisition. I mean, you're going to have the GAO come in and audit this monetary policy decisions on a decision-by-decision basis on a fast time frame, subject to terms of reference drawn up by either the House or the Senate committee. Imagine what would happen. I'm just guessing that control of the House and the Senate will pass back and forth between the two parties in coming decades based on recent history. So someone else will control one of these committees, someone not aligned with the current Republican majority on this committee. What pressure are they going to be putting on the central bank? Is that what you want? I think, as Ms. Waters said, you want an independent central bank with experts making the decisions. You need certainly to have accountability. Absolutely. I think that's a very important goal. But the experts have to have the ability to make these decisions. And you're not going to get, what you're going to get from this is a massive amount of volatility in financial markets. Imagine the research reports that people are going to be putting out. Remember when TARP was turned down at the first time of asking in the House? Remember the volatility that came out of that? That's what you'll be getting on a week-by-week basis under this legislation. Why would anyone who's pro-business, who's pro-private sector investment want that? I don't understand. Second set of points are with regard to the cost-benefit analysis, the stress test, and the points about international negotiations. These are just designed to hamper effective regulation of any kind. The Federal Reserve does already go for extensive public comments on any major rule. Take, for example, the Volcker Rule, about which I testified for this committee not too long ago. There was a very detailed, extensive period. There was a lot of oversight. And when there was a particular part of the Volcker Rule that was not satisfactory to both Republicans and Democrats, you had the hearing in January. They fixed it. That's how the system is supposed to work. That is how it works. What you've got with the cost-benefit analysis is a set of traps and snares that are designed to trip the regulators in front of the courts, procedural traps. The cost-benefit analysis approach doesn't even consider the major costs of excessive risk-taking in the financial system. It never has. The CFTC version, the SEC version, the versions put forward for the Fed. Massive financial crisis, loss of 1 year's GDP at least, damage across the American economy from which we're still struggling to recover, doesn't figure in any of those tests. The stress test proposal would simply allow the banks to game the system more effectively. The details, the specifications, the scenarios are given out by the Fed in advance. What they don't tell you is the details of their models. Why do the banks want to know the models? So they can game the models. Go back and read the documents that came out of the London Whale case. Look at the very detailed micro way in which the JP Morgan executive was telling her trader how to game the reporting in order to pass the various Fed requirements. Look at that language. That's what they'll be doing on a regular basis. And the international negotiations. You're putting a requirement in here that would completely prevent any attempt by the Fed to deal with international crises. Mr. Taylor says we should be able to do that, and he's absolutely right. You can't agree a swap line without all this notification period. You can't have any of the regular daily conversations that I used to participate in when I was chief economist at the International Monetary Fund, at least as witnessing those negotiations. The Fed wouldn't be able to do any of that. I do think the points about vice chair for supervision of the legislation make sense. I do agree that having governors having their own staff is sensible. But I would say, particularly to Mr. Garrett, on these points about accountability and transparency, which are very good points, and which were also in the earlier version of your legislation, you should be focusing more on the reserve banks. That's where there's an anachronism in the system. The reserve banks, presidents of which are sitting on the FOMC, are separate from, not accountable to Congress. Their presidents are not appointed by anyone who is not appointed in a direct fashion that's accountable to Congress. It's quite an anomaly and a leftover from the 1913 Act. And particularly, I would emphasize the New York Fed. The New York Fed is a terrible problem, Mr. Garrett, from your perspective. And the head of the New York Fed is vice chair of the FOMC. He has a quasi-fiscal responsibility. He is not appointed by the President of the United States. He is not subject to confirmation by the U.S. Senate. He doesn't come and testify to you on a regular basis. That job, President of the New York Fed, should become a presidential appointment like the Board of Governors of the Federal Reserve System. Thank you.
I thank each of the panelists for their testimony. Chair now recognizes himself for 5 minutes. Dr. Taylor, what are the risks to our economy if we do not pass Section 2 of this bill?
I think in many respects you can look at the last few years to see the risks. It would be a period where we could again have the kind of bad economic performance we had. Remember, we had a serious financial crisis, we had a great recession, and we've had a unfortunately slow recovery. And that is during this period where people have assessed the policy have not been predictable and rule-like. And I would go back to 2003, 4, and 5 when the rates were held very low for too long. It's a period where people are saying, is that happening now? So I think the most likely risk is we would continue with this subpar economic performance, which no one wants to have. Again, I can't believe we'd have to go through that again, but we run that risk very, very greatly.
Dr. Calabria, a portion of your written testimony that you did not deliver orally, since you did not focus on Section 2, says, quote, Section 2 does not require a specific model. In no way does it limit the Fed's choice of model. It simply requires the Fed to publicly share the model. All of the Fed's actions in recent years would have still been possible had Section 2 been in place. There's nothing in Section 2 that is inconsistent with the Fed's dual mandate, nor is there anything in Section 2 that would require the Fed to raise or lower rates. There is no compromise of the Fed's operational independence. Dr. Taylor, do you agree with Dr. Calabria's assessment?
Yes, very much so. I think the idea here is to exercise oversight that's responsibility of the Congress, but to continue to allow this independent agency to conduct monetary policy. The difference from current law is that the central bank would be required to describe its strategy for setting its interest rate, for example, in a manner that can be understood and be analyzed. And that's frequently called a policy rule, which is simply a way to describe how the interest rate changes under certain circumstances. It's used all the time. The Fed is always looking at policy rules right now, but they just don't articulate it or talk about it very much. So I agree very much with this idea. This doesn't really change the independence of the Fed. It has the ability to set its policy. Those who at the Fed who may disagree with this but sympathetic with policy rules say, well, we'll just do this on our own. But I think the truth is, if you look at the history, they've gone back and forth, and that has not been enough. So I think the experience is that we have to do something more. You have to hold them accountable to follow the kind of policy that works.
In my opening statement, I quoted Chair Yellen from an earlier point in her career where I believe she said rules-based monetary policy. I think she was actually speaking specifically of your rule is what, quote, unquote, sensible central bankers do. I questioned her about this in her last Humphrey Hawkins testimony. I don't have her testimony right in front of me. I hope I can do it justice. I think the essence of her answer was that she does not disagree with herself, but I think she believes that the timing is wrong. Do you have a comment on that, and when might the timing be right if it's wrong today?
Well, I've talked to Chair Yellen for many, many years, decades probably, about this issue, and she's always been supportive of this kind of approach. What she says now is the time is not quite right. We're still not in a normal situation. We're still too close to that financial crisis. And I just disagree with that. I think it is time to get back to the kind of policy that worked well in the 80s and 90s until recently. And in a way, that's, to me, promising, because if it's the disagreement is about when, not if, then we're making progress. This legislation goes further in thinking not just about the current chair, but about the future of the Federal Reserve and how it operates. So I think it's very important to put in place something that provides the continuity in this very sensible way, which we've had so much experience with.
Dr. Calabria, in your written testimony, again, that you did not deliver orally, with respect to Section 2, you also said, quote, "Why is it important to reveal the Fed's current operating model so that it can be examined and tested by those outside the Fed? Only under such examination can we learn how accurately that model captures the real world." Would you please elaborate?
So let's start out with the observation that all policy choices entail some rule. It's either implicit or explicit. You have a model of how you believe the world works when you decide that A is going to result in B. So certainly the Fed is operating by a rule today. The fact is, whether is that rule effective or not? I'm sure that if Chair Yellen was here, she would probably express some concern that the last few years have not exactly worked out how the Fed anticipated it would. And I certainly think that's evidenced by how far off their forecasts have regularly been. So if we're going to try to figure out exactly why have they been off, and my suspicion is certainly within the Federal Reserve Board, they're asking themselves this question every day: why have our forecasts wildly been off every time? It's because they have to rethink the model. Now, so we could either rely on a small number of people across town to evaluate that model, or we can try to incorporate all of the rest of us to try to figure out why that model works or does not work. So my point would be, we don't really know ahead of time. Economists have spent a lot of time. I think with all modesty, we should probably all economists admit we don't 100%, maybe not even 50% know how the economy works. And you're not going to figure that out unless you put models out there, unless you test them, unless you disprove them and move on to other models. And again, I would emphasize, the Fed is operating under a model. It's time they shared it with the rest of us. I think it's, again, fairly clear that that model has not successfully predicted the responses of the economy, and that we all try to figure out what actually would work.
Chair now recognizes the ranking member.
Thank you very much, Mr. Chairman. Dr. Johnson, you expressed a number of concerns with the impact of requiring the Fed's monetary policy makers to prescribe a detailed rule for setting monetary policy, which would then be subject to audits by the Government Accountability Office. First of all, I am absolutely intrigued by the fact that we have our witnesses here today talking about why the Fed should have independence and how it should not have interference by the Congress of the United States. On the other hand, the testimony here by Dr. Taylor and others is basically a prescription for interference by prescribing a rule. But I would like you at this time, Mr. Johnson, to elaborate a bit on why the imposition of GAO audits of a monetary policy rule would have a chilling effect, creating obstacles to productive work and bringing more partisan pressure to bear, as you put it in your testimony. And at the same time, our witnesses have said, oh, the Feds will have all the flexibility that they want and they need. So there are some contradictions here. Could you comment on these GAO audits?
Certainly, Congresswoman. So what we've learned over 100 years, and what's also been learned in other industrial democracies, is that you can and should have specification of the objectives for monetary policy coming from the legislature, in our case, coming from governments in other different kinds of democracies. So the you tell the central bank what objectives you want. In our case, we have a so-called dual mandate. And then the central bank decides how to achieve those objectives using the expert analysis that Mr. Henseling accurately described in his article. What you're doing with this GAO structure is you're putting in a set of people, as I read the law, who have this sort of prosecutorial power. They're auditing, they're going through everyone's emails, they're reconstructing exactly the based on what was happened, they're understanding the models that were used or were not used. They're doing this on a very rapid basis, according to the timeline in this legislation. The exact terms of reference to those audits actually will be specified on a case-by-case basis according to the legislation. So you don't know exactly what's happening on this fishing expedition. What are they going after? What are they looking for? What's the issue? And it would introduce a huge amount of uncertainty for the individuals. Do individual federal staffers need to obtain the advice of legal counsel, for example, which is what happens when GAO goes in or inspectors general look at actions at the SEC and other places. All of this has got to affect how these experts interact. Are they just arguing about the substance, or are they thinking, okay, how is this going to look to the GAO? What's the pressure that's coming to us from different people in Congress, from the House committee and presumably from the Senate committee? I really don't see that is going to help you get the best expert analysis and decision-making to obtain the objectives that you, Congress, have set for the central bank.
Let me ask, Ms. Pierce, do you believe that the individuals on the Open Markets Committee of the Feds, whether they rotate or not, do you believe that they have the expertise that's necessary to do the job, and do you think that the confirmation that they have been given is sufficient for them to be able to have good judgment?
I certainly wouldn't question the judgment of the members of the FOMC. I would say that I think we all benefit from getting input from other people, and so putting out a rule to say what you do and getting other people to give you feedback on that is generally helpful for any expert in making a decision.
So what you're basically saying is that in addition to their expertise and their backgrounds, that perhaps those of you in academia should have more input and more advice and more influence on the Feds.
Well, I certainly wouldn't weigh in on monetary policy since I'm a lawyer, and I think I would get killed by my co-panelists if I said that I would, so I would stay out of that.
Let Mr. Johnson weigh in on this, please.
Yes, members of the, so I think it's good to discuss members of the FOMC. There's a range of opinions, and that's how Congress has decided, I think correctly, that monetary policy should be resolved through this process of deliberation and the Open Market Committee. These people communicate all the time. They're always giving speeches. They're always interacting. They have, if you talk about the regional feds, they have various kinds of advisory committees they're engaged with. Same thing is true at the board. Perhaps we might wish for more openness, certainly at the regional fed level. That's a fair question. But they're absolutely engaged and communicating, and people are pressing them all the time with these opinions. That's a very healthy part of our democracy.
Thank you. Yield back the balance of my time.
Chair now recognizes the gentleman from California, Mr. Campbell, the chairman of the Monetary and Policy Trade Subcommittee.
Thank you, Mr. Chairman, and thank all of you. Rather than me really ask some questions here, Dr. Johnson, you've given your very spirited opposition. While ostensibly agreeing with Dr. Taylor on lots of things, you have a very emotional and spirited disagreement with the elements of this bill, particularly Section 2, I guess. There's some elements that you agree with. So, Dr. Taylor, can you respond to some of his objections, please?
Yes, I think that as I hear Simon Johnson talk, his focus is not so much on whether we should have a rules-based policy. It sounds like there's agreement there, but it's just on how the accountability is brought into play. Now, I think you need
can I stop you a second, Dr. Johnson, would you agree with that?
If the Federal Reserve, the Board of Governors and the FOMC were to decide to have a rule or to move closer towards Mr. Taylor, I'm not going to raise objections to that. I don't think that will be particularly a politically contentious question. You're decentralizing the decision-making to the experts. That's the principle under which we're operating. It's the imposition from the outside of the rule with this GAO
Dr.
audit.
Johnson, if I can, we're not telling them what the rule should be. I mean, well, how is that any different than, the Federal Reserve is chartered by Congress. I mean, it is the elected body here and the President that have to set these things up, and we have to provide some accountability. That's the way the Constitution works. So we're not telling them what the rule should be. We're just saying do a rule because history shows that that's more effective and also provides more accountability to the market. I mean, one of the things that frustrates me, I'll just say, is that I see today out in the real world, it seems like we used to, when rules were in play, we used to sit around and say, what's going to happen to the economy? What's happening in the markets? What are my customers saying? What are my suppliers saying, et cetera, et cetera. Now all anybody cares about is what's the Fed going to do? It's like they're running the whole show, and that's, to me, that's a distortion of the way the economy and the private sector should work. So we're not telling them what the rule should be. We're not even telling them they have to follow it. Well, but we're saying, please give the market some stability here. Please give people so that there's some basis upon which they're operating, other than tomorrow morning the Fed wakes up and decides, let's do more quantitative easing. Let's suck it back. Let's put more in. Let's do this and that, and throws everybody for a loop.
Mr. Campbell, if you're not giving the rule, why are you specifying in this detail the reference policy rule that has these specific ingredients? And then why are you putting all this pressure on them to have this directive policy rule that needs to be in alignment? I think that's what in alignment with, or close to, or you have to come and explain on a regular basis why it deviates, and then you send the GAO in to check why this deviation is. It's like a police state for the central bank.
The GAO? Having the GAO audit a government agency is a police. The police state is the government they're auditing.
So's the Department
That's
of Justice.
the police
So's
state.
the Department of Justice.
The police state is the IRS. The police state is the EPA. The police state is all that. That's the police state. Auditing is not a police state. Now I know you're really ticking me off, but I'm going to go to Dr. Taylor here, who is itching to respond to your comments.
Well, this idea of the reference rule, let's remember the reference rule is the Taylor rule. In fact, I kind of like the idea of reference rule rather than Taylor rule because it allows me to sound more objective when I talk about it. But it doesn't require the Fed to be following the reference rule by any means. It simply says, hey, there's this reference rule out there that there have been thousands of papers written about. And it appears, if you go to any market discussion, it's out there being discussed. Anybody that talks about a policy rule compares it to this reference rule. So what is so harmful by just saying as a reference the Fed ought to do that? It's not required to follow it. It's just required to have a discussion like everybody else is having a discussion. And so I think it's a good idea to have it in, but it doesn't really say the Fed should follow it. Actually, if I could just add, the current chair of the Fed recently gave a speech comparing what she thinks the policy should be with the reference rule. And so it's just a continuation of that thing, which I think is a healthy way to do it. And they would have to do that as part of their analysis.
If the central bank, I think if the central bank and if the chairman of the Fed can persuade a college to move in the direction of having this rule or making these comparisons, I'm in favor. I'm in favor of delegation to the experts, as Mr. Hensling said in his article. That is what has served us better over the past 100 years than some other arrangements that we've tried and that other countries have tried.
All right. Thank you both for that. And in my last 10 seconds, I'll just reiterate what I said before. I'm supportive of this legislation, but it can be modified. That's why we're having this hearing. Maybe it needs some tweaks, maybe there's some things, but we really will be best if we can get the economy out of operating only on Fed action and instead operating on the action of the real economy. And that's what I hope this can move us to do, and I yield back.
Chair now recognizes gentlelady from New York, Ms. Maloney, ranking member of the Capital Markets Subcommittee.
Thank you. Dr. Johnson, I'd like to ask you about the restrictions that the bill places on United States regulators and with the Fed and otherwise, ability to negotiate with their international counterparts, having to inform Congress and so forth. As someone who used to work at the IMF, can you give us some insights on whether these kinds of international negotiations are important, especially in such a globally integrated market such as finance? And would the restrictions in the bill put the United States at a competitive disadvantage in finance and being part of these negotiations? Thank you.
Thank you, Congresswoman. I think it's a very, very important issue. It depends, of course, what you mean by negotiations. The legislation is somewhat vague on that. But if you mean entering into discussions of substance about policy and about what we're going to do, what you're going to do, and how there might be some quid pro quo, this happens all the time. And these are, particularly if you're talking about financial regulation, you're talking about large, complex banks and other kinds of financial institutions operating across borders, for example, to the extent to which they comply with capital requirements in different places, to the extent that they are generating or not generating systemic risk in various places, to the extent that you're providing support or not providing support to various aspects of the system. These are things that central banks talk about all the time. Now, this is a delegation to experts, again. There should be accountability. When there was a financial crisis, they were up here a lot, I think 37 or 39 times they testified before Congress in 2009. Those are the numbers that I've seen. But this would tie their hands. This says you've got to give 90 days notice to the Congress and in various other ways and getting public comment before you have any kind of negotiation with anyone, including central banks. That is going to make it much harder to operate central banking in any reasonable fashion. And your point about competitive disadvantages is a good one. I think if other central banks are able to operate in a better, more functional way, for example, within Europe, between the Bank of England and the European Central Bank, for example, and the Swiss National Bank, and we're excluded from that, at the moment we're in that inner core of the most credible, well-run central banks in the world. If we have to step back from that, if our central bank can't go there or has to be mute in all of those meetings, that's a serious disadvantage to the broader competitiveness, not just of our financial sector, but much more broadly of our economy.
Could you elaborate more? How do you see that would hurt our economy and our jobs in our country?
Well, I think the most important issue that comes up on a daily basis with regard to what is
Dr. Johnson, I'm not sure your microphone might have not been turned off.
Okay, thank you. I think it's the issue comes up with regards to capital, for example. And there's a lot of agreement across the political spectrum that we need high, strong capital requirements. A lot of it should be Tier 1, common equity, so it's fully loss-absorbing and so on. Now, these financial institutions that we've allowed to operate across borders are very complicated. They have different capital requirements in different places. They are, frankly, gaming the system on a hour-by-hour basis, if not more frequently than that. And the central bankers and other regulators need to be in constant communication with regard to, is there sufficient capital underlying, protecting the taxpayer against the risks that are being generated by these various financial institutions. If you run your capital requirements in a sensible way and recognizing all the cross-border dimensions, then you get a safer system. Not, I'm afraid to say, a completely safe system, but a safer system. If you've got to exist in isolation, if you can only look at that part of JP Morgan Chase or that part of BNP Paribas that's in your jurisdiction, because you're not allowed to talk to anyone else because that will be considered a negotiation, well, that's going to be a much less effective regulatory system. And everyone across the political spectrum agrees we should regulate capital. There has to be minimum levels of equity capital in this business.
Okay. Do you think that the cost-benefit requirements that this bill would impose on the Fed and the FSOC would just slow the rulemaking process down by suing in court? And in your opinion, would this lead to better regulatory outcomes from a systemic risk perspective?
I think that the cost-benefit analysis as formulated here is designed to trip up the regulator. The courts, as you know, only test on procedural grounds whether you checked every single box. If you didn't respond to a single report that was put out at the behest of a single lobbyist on the industry side, you have trouble with that. There is no standing for the public in this cost-benefit analysis. If the public thinks that the regulation is too weak, you don't have standing to sue. The people who have standing to sue are the industry who filed 1,000 comment letters and another 1,000 technical reports, and you didn't get to the 999th one of them, then the whole thing is going to get thrown back to you. Of course, regulation becomes less effective, and you're going to have, over the medium term, more systemic risk, more danger, more risk of a massive financial crisis and another deep global recession.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Vice Chairman of the Monetary Policy Subcommittee, co-author of the legislation.
Thank you, Mr. Chairman. Man, there's a lot to cover. So, first of all, I am going to talk a little bit about oversight, and I, like Mr. Campbell, was finding myself getting more and more steamed. I cannot figure out, Mr. Chairman, why so many of my colleagues are willing to hand over their constitutional standing, I would argue their constitutional duty to fulfill oversight responsibility. All right, so I started Googling oversight. CRS report pops up. CRS says, quote, congressional, but this is Wikipedia, so we're not going real deep here. We can go even further. Congressional oversight refers to oversight by the United States Congress on the executive branch, including the numerous federal agencies, U.S. federal agencies. Congressional oversight refers to the review, monitoring, and supervision of federal agencies' programs, activities, and policy implementation. Congress exercises this power largely through its congressional committee system. I then went even deeper. My son Garrett, who we've referred to and talked to about, just got done with AP government. So guess what? I went to the AP government flashcards on oversight. It says roughly the same thing. What I can't figure out is why colleagues here are willing day in and day out to hand that responsibility over to an administration regardless of whether there's a D or an R behind it. What happened to the people that are going to go and fight for their legislative standing, constitutional standing? I don't understand this. Second, let's get specific about my bill and Mr. Garrett's bill. Section 2C, all right? It's page 5 for those following you in the program, all right? Page 5 through page 8 is where we talk about this stuff, all right? We clearly lay out that submitting a directive policy, requirements for the directive policy rule, and then going into what that GAO report is. It says when a rule is materially changed, that means significant, right, Ms. Pierce, the attorney? Significantly changed. Then and only then will they go in. And oh, by the way, that's after the open rules market submits, next page on page 8, GAO approval of the update. The Federal Open Market Committee shall submit an explanation for that determination that it either A, cannot or should not be achieved. They submit an explanation to that determination and an update version of the directive policy to the comptroller of the General of the United States and the appropriate congressional committees. Oh yeah, by the way, that's us doing our oversight. So I think we have to look at this, and it seems to me that it is clear if the Fed complies with the law and submits a real rule, none of what Dr. Johnson is describing can happen. Submit a rule and then explain it. That's all we're saying. We're not saying what the rule is. We're not saying what the final goal is. Explain yourself. So, all right, now having gotten that out of my system, Dr. Taylor, I am curious who and what other central banks around the world use a rules-based policy, and what's been their experience?
I would say many have during particular periods, and when they have, things have worked quite well. I would put it this way. But they sometimes deviate, some more than others. But there's quite a lot of studies that, as best we can, determine when a central bank is coming close to a rule, or their policies are described by a rule like this or others.
And have they experienced Spanish Inquisition within their own oversight actually structures?
So there's different approaches. Some countries require that the central bank follow a particular inflation target. Others, the banks adopt that themselves. But no, I don't know of this Inquisition problem occurring at all.
Let the record note that he's smirking while he's saying that. So, and I'm curious, Dr. Taylor, Dr. Calabria, do the other central banks do the regulatory function to the level that we are seeing under this change with the Federal Reserve because of Dodd-Frank?
Well, it's certainly mixed. Some central banks around the world have no bank regulatory function. Some do not.
How about the ones that are more successful?
There's
than
actually
others?
a recent study by Barry Eichengreen at UC Berkeley, certainly no free market radical, who came to the conclusion that those central banks that do not do bank regulation have less inflation and more economic stability. So I go back to an earlier point I made, which is, I think we need to rethink whether the Federal Reserve should be the primary bank regulator here. I do want to make a point before we end, though. A lot of the conversation has painted the GAO. Let me say, as someone who's often disagreed with GAO, but as someone who has requested GAO reports as a staffer, someone who in the executive branch has been on the receiving end of GAO audits, I know a few parts of the federal government that are less political than GAO. They are a very unbiased organization. They are not like inspector generals. They do not have subpoena power. They don't go around carrying guns. Lots of, as you know, lots of agencies ignore them all the time. but I think that they are a very apolitical organization, as apolitical as you get in the federal government.
All right. And unfortunately, my time has expired. But
time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Dr. Johnson, at the height of the financial crisis, small businesses were severely impacted by a lack of access to capital. There wasn't a day when this committee held a hearing where we didn't hear members from both sides of the aisle talking about the fact that their businesses were having trouble accessing capital. So I would like to hear from you, how could this bill impact the supply of credit for small businesses during periods of economic instability?
Well, Congresswoman, I think it's an important question and obviously not a hypothetical one. We've recently had this experience. The point of delegating to experts is so that they can at various points decide that you need to take some actions different from what would be standard. And in the case of a financial crisis, I think all the experts I know would argue in favor of extraordinary measures to try and preserve exactly the kind of thing you're talking about, which is credit available to small business, which has probably not been a big part of causing the crisis and which is a big part of getting the economic recovery.
Correct.
So this is where we come to the issue of the chilling effect. I'm completely in favor of oversight by Congress, and that, of course, was the point of all the hearings that you had, not just with small business, but also with the Federal Reserve. That's why they were here so often explaining what they were doing. We have a lot of very effective oversight built into the American system. But when does that oversight shade over and become a chilling effect? When do the experts feel that they can't make the decision on the basis of that apolitical expert knowledge? When do they feel that there's some sort of political agenda hanging over them? I agree that the GAO in some instances is apolitical. But here in this legislation, they would get specific instructions on the terms of each audit from this or the committee or the Senate counterpart. That's got to have a chilling effect.
Thank you. Ms. Pierce, Section 7 imposes cost-benefit provisions similar to those that will be imposed on the Security and Exchange Commission. And it will require for conducting economic analysis, cost economic analysis. This unfairly ignores the extensive analysis that economists and experts at the Federal Reserve already do. They have to comply with the Paperwork Reduction Act, the Congressional Review Act, and the Regulatory Flexibility Act. So, although cost analysis is a seemingly common sense requirement, in practice, this provision will be highly unworkable. And I would like for you to explain to me how should the Federal Reserve value the benefits of preventing a financial crisis or averting a market failure associated with the absence of a particular regulation. How would the Federal Reserve prove in court that the estimated benefits are reasonable if the crisis the Federal Reserve seeks to prevent through its regulation has never occurred? Will you explain that?
Yeah, I think that you raised a really important question, which is tying a particular rule to a crisis. And so we often try to justify rules by pointing to a financial crisis and saying, well, surely we want to prevent another crisis, and we can all agree on that. But I think the discipline of an economic analysis requires the Fed to look at a particular rule and say this is the role that it would play in preventing another financial crisis. And it can make predictions about what the costs would be of a crisis and what benefits you would get. And so then having that very rigorous and clear, you make your assumptions clear so that other people can challenge your assumptions. And you make the data clear that you're using, and then people can provide you additional data to challenge that. And then if that does get challenged in court, then the court can look and they can, it's more of a procedural thing to see what the Fed actually did.
Yeah. So, Ms. Pierce, you don't feel, and Dr. Johnson, if you would like to answer, you don't feel that this type of regulatory requirement, will not prevent the Federal Reserve to act accordingly when we are facing an economic crisis?
Not at all. It gives the Fed, it may take the Fed a little bit longer to adopt a rule, but these rules are in place for years and years, and so what we'll end up with is we'll end up with higher quality rules that stand the test of time better because they'll have gone through a rigorous process.
So you don't feel that it will be an attempt to bring the federal financial regulatory oversight to a halt?
The time of the gentlelady has expired. The chair now recognizes the gentlelady from West Virginia, Ms. Capito, chair of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. I want to thank the panel, too. One of the issues that I've discussed with current and former Fed Reserve Chair is the effect that this low interest rate environment has had on our savers and particularly our seniors. I represent West Virginia. We have an elderly population, and a lot of our folks are trying to live within the boundaries of what they had planned for, and this fixed income products like CDs and everything to support their income. So my question is, would a rule-based monetary policy produce a more balanced approach that doesn't overly penalize a saver, particularly those in their senior years who have actually saved and planned for the future? Do you see this rules-based monetary policy having any effect on that? And Dr. Calabria, I see you shaking your head, so I'll give you a shot first.
Well, first let's start out, because I think there's been implied that a rules-based policy would necessarily always result in higher rates. That's not necessarily the case. There's certainly times in the past when a rules-based policy would have suggested lower rates, but I would be first to say that certainly my read of the evidence, and I'll defer to Dr. Taylor on this, but certainly my read of the evidence seems to suggest that a rules-based policy would on average have suggested higher rates over the last decade, and certainly over the last few years.
Would it, well, Dr. Taylor, go ahead, and then I'll ask a follow-up.
First of all, it's very important to think about a policy rule doesn't necessarily mean higher rates or lower rates. It means that the rates are adjusted in accordance with the state of the economy,
right,
the way it works. Right now, I would say most policy rules that are out there would suggest rates would be not zero, but positive, at least slightly positive. I never would say we go there instantly, but it would be, it should have been something that we could have been prepared for. So in that sense, the zero rates would not still be there.
I would say,
I believe to some extent that would be because the economy was doing better.
Right.
A different policy or a better economy and therefore higher rates. But even without that, they would be higher. And the zero rates cause other problems besides the ones you're mentioning, that the money market doesn't operate very well at that point. To the extent that quantitative easing is part of that policy, it's a massive intervention into the capital markets. Price discovery is affected, and so there's a lot of unintended consequences, as well as the fact that it's affecting frequently older people, causing them to take extra risks, et cetera.
One of the things I think that, correct me if I'm wrong here, I think it would provide for would be the predictability of where to go. So if you're looking for buying short-term, long-term, or somebody's helping you with financial planning, you may be able to plan slightly better. That's one of the advantages I see. Dr. Johnson.
I think the reason interest rates are so low and the reason that your constituents are having so much trouble, the elderly ones, is because we had this massive financial crisis. And that we should be addressing through other measures, including much higher capital requirements that would be complementary.
Which I think we are, correct?
And so I'd like to quote John Allison, who's the head of the Cato Institute and a former BB&T executive, who was arguing recently for a 20% capital ratio. I think that's something you can agree on across the political divide here that would exactly address your problem, Mrs. Capito, which is to make the world safer for people who rely on those fixed income products to finance their retirement.
Yeah, but if I make a point, because I
yes.
do agree with this, but I do want, this ties back to an earlier point, because Professor Johnson has repeatedly told us that we need to rely on the expertise of experts. I will remind him a decade ago the Federal Reserve was arguing for eliminating any sort of leverage ratio in the Basel capital standards. And certainly when I was a staffer on the committee, and I applaud the efforts then of Senator Shelby and Senator Sarbanes to push back on the Fed, we would have not have heard if it weren't from the FDIC telling on them, basically. So, having this advance notice of what's going internationally delayed the implementation of Basel II, which meant that American banks actually had as little capital as they had more capital than they would have had they implemented Basel II.
Well, there's no
Well,
question. There's
hold
no
on.
question.
I'm going to. I'll let you guys debate when you get
My
off the-
point being is that I don't.
I want to ask one more question on the cost-benefit analysis, because this is something that I think is being held out as some sort of villain here, when I really think we've heard repeatedly in this committee from testimony from all kinds of employers and financial institutions, et cetera, on the not so much the burden of one additional regulation, but the cumulative burden. And I think if you're looking at a cost-benefit analysis of adding a new regulation rule, that's where the value could really be. It's not looking so much at one singular rule or regulation, but looking at how it's reacting and interacting with all of the other ones that are already in place. And with that, I see I've lost the rest of my time, but thank you.
Chair now recognizes the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Thank you, witnesses, for being here. I just have one question, but I want to preface it by expressing personal opinion, which is that after 6 years during which our economy teetered on the very edge of collapse, our country is moving forward, and I think most of the economic news that we are seeing and reading about is positive, and we seem to have climbed out of the depths of the Great Recession. We're increasing our GDP, lowering the rate of unemployment, although the unemployment numbers seem to be a bit stingy, and I think there are some socioeconomic reasons for that. But we can see that we are improving the state of an almost devastated housing market. Now, housing sales, at least based on what I'm hearing from my realtors, the realtors in my district, are the strongest they've been since 2006. And so I'm, applauding the economic growth, and I believe the Fed has taken many proactive and, yes, unconventional steps to resuscitate our economy. And so, Dr. Johnson, I'm wondering whether or not you think, and frankly all of the members of the panel, that had the proposed reform been effective during the beginning of the 2008 financial crisis, do you think the Federal Reserve would have been able to do what they've done in the midst of being constrained from taking proactive measures to get us back on track?
I think that's a very good question, Congressman, exactly on target. Now, I understand that hypothetically you could read the legislation to say there wouldn't be a constraint. The Fed could just say it's a crisis, we're going to do these dramatic things. But if you think back to and remember 2007, 2008, as the crisis began to develop, how much controversy there was about what the Fed should be doing, how it should be doing it, the pressures that they faced. You're going to add this on top of all of that, and there was appropriate oversight, right? So there was plenty of times when Mr. Bernanke and his colleagues appeared before this committee and other committees to explain what they were doing. But you would add another layer on top of here, which could potentially have been about multiple audits and creating this uncertainty, for example, for financial markets. Is this or that Fed decision going to be second-guessed, or is there going to be pressure to overturn it from a particular House or Senate committee? I don't think having Congress involved in this kind of micro-management, which is what it is, of the Federal Reserve is a good idea in general. I'm particularly worried about what would happen at times of national emergency, including financial crisis.
Yeah, I mean, I'm just, yes, I'd like you to respond. I just, I need to say before you respond, my thought was, because I was here during that time, I think everybody on this committee is reasonably sharp. Some of us have degrees in geography and physical education. I'm wondering, how impactful and positive congressional interference would have been.
So, Congressman, I think it's very important to go back in time before the crisis hit, to answer your question. There was a period, especially 2003 and 4 and 5, where the interest rate was very low and then was raised very slowly. By most analyses, and there is disagreement, by most analyses, that was a period where the Fed deviated from the kind of rule that worked well in the 80s and 90s until that time. I believe that was one of the reasons for the search for yield, the excesses in the housing market, not everything, but which ultimately led to the bust and therefore to this terrible situation we had in the crisis, in the recession, and the slow recovery now. So to me, if this kind of legislation had been in place then, and remember in the year 2000, the legislation was reformed to take out reporting requirements. But if in 2000, say for example, this kind of legislation had been put in place instead, at least the Fed would have been up here explaining and questioning why it deviated from its policy. And I think ultimately would have deviated less, and we would have been in a much better situation. The economy would have performed much better in the last decade than it has.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of the Capital Markets Subcommittee and co-author of the legislation.
So thanks, Mr. Chairman. So let's look to see where we all agree. And it sounds actually there are a number of points that the entire panel actually do agree on the underlying legislation. Mr. Campbell from California raised a point. He says, you know, the markets or the businesses should not be so focused on what the Fed is doing every day. They should be focused on what the markets are doing, what consumer demand is, what the volatility in the markets, what suppliers are, and that sort of thing, and not so much on the Fed. And I think if I looked at the panel, you would all agree with Mr. Campbell's assessment that we're too focused on the Fed's activity daily as opposed to, do we get a nod, sort of like that? Oh, sort of, not Mr. Johnson. So then the question is how do we sort of turn that around? Now, one piece in the bill simply asks that the Fed chair, instead of coming up to Congress twice a year, that he or she comes up to here 4 times a year, quarterly. Does anybody disagree that having the Fed chair come up here quarterly as opposed to twice a year, is that a bad thing as far as, just say yes or no? Does anybody disagree with that?
Yeah, I disagree with that.
Oh, okay. See, I thought we could get over saying that we agree. So I guess my next question was going to be, does anybody disagree with the next provision, Section 6, which says on the supervisory and regulatory side, we have that the Fed Vice Chair of Supervision should also, as their responsibilities, comes up once in a while, or actually semi-annually, to testify as far as regulation. Does anybody disagree that he or she should be coming on up, testifying semi-annually what they're doing? Does anybody disagree with that one?
I do more than agree, Mr. Garrett. I think you've got very good language in there about who should testify when there isn't a vice chairman for supervision. Yeah. In terms of implementing Dodd-Frank, that's essential. So
there is some disagreement as to how often the Fed chair should become here. You know, and the question there is, what good does it do actually when the Fed chair does come here? Because, as you know, the Fed chair was here, what was it, Mr. Chairman, about 4 months ago, and at that time we had some specific questions as to what she was doing, and we asked them, and she said, would you get back to us? 4 months later, we just get our answers now. Would anybody say that a 4-month response from the Fed is a timely and responsive and responsible response from the Fed? Does anybody say that's timely, responsive, and responsible?
But, Mr. Garrett, what exactly were the questions? I mean, to what extent were they detailed, technical,
we got the
hard questions, or the straightforward questions? We don't know those details.
Well, then I guess the American public doesn't know the answers either, and that goes to the overarching question of, to my first question, is if we can't have certainty in the marketplace, then the market is constantly, continually going to be looking on a daily basis to what the Fed is doing, and that's all this underlying the legislation is trying to do, is to provide certainty in the marketplace. We're not telling the Fed what to do. We're just saying, please let us know what you're doing and give it to us in a timely manner. Now, one way to do that is to help us out with an economic analysis. Now, this wasn't my idea. We grafted our language from President Clinton's and President Obama's executive order. Apparently, those two gentlemen thought it was prudent that the American public have from their federal agencies a economic cost-benefit analysis before agencies take actions to see whether the cost of something is greater than the benefit. So does anybody disagree with President Clinton and President Obama when they signed executive orders saying that there should be cost-benefit analysis for the agencies that they did? I guess there's always
Can you take the executive order cost-benefit formulation to the courts in the same way that you could take your legislated cost-benefit analysis of the course, Mr. Garrett?
Well, actually, we can, because the courts have been able to do that, and the district court was quite able to do that. As a matter of fact, the district courts was able to do that and overturned the decision of the SEC, saying that the SEC, which the President Executive Order did not apply to, but we suggested that they follow, and the SEC chairwoman said she would follow, and the courts delved into it and said, yes, they can do an analysis, and the SEC did it.
In that case, I think President Obama and President Clinton got it wrong, on the terms that you specified. I don't think the court should have that ability to trip you up on these technical details.
Well, it's interesting that once again that I have to be here and to be a defender of President Clinton and a defender of President Obama. But if that's my role, then I am willing to do it in this one regard, because I think the American public does have a right to have a balance done on the benefits of the cost and the analysis. Let's get to the issue of transparency in only 36 seconds. Dr. Calabria, in your testimony, you write that the independence of the Fed has been greatly eroded by the revolving door between the Fed, Reserve, and economic policymakers in the executive branch. All of our discussion so far has been about how much overt influence that we're going to have as members of Congress. Could you talk about how much overt influence the executive has had?
Let's start look at the current board. 3 out of 5 members of the current board worked in the Clinton White House, not the Clinton administration, the Clinton White House. So if you want an apolitical Fed, this is not it. So as I suggest in my testimony, and I think this is apply across any administration, no one should be eligible to be a Fed board for at least 4 years after they have left an executive branch appointment. There's really just too much a revolving door between Wall Street, Treasury, and the Fed.
Thank you. And I see my time has expired. Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you. Dr. Taylor, 3.5 years ago, you were a co-author of an open letter to Chairman Bernanke, basically criticizing his decision to do the large-scale asset purchases and predicting, among other things, that currency debasement and inflation. We've been hearing that consistently over the last 3.5 years from the other my members across the aisle, my colleagues across the aisle. And I was wondering if each of you could go in 1 or 2 sentences, explain why those predictions have been so wrong for so long. And try to limit it to 2 sentences so we can.
So my criticism of the quantitative easing and related activities is it had 2 risks. One is a downside risk, the uncertainty that caused, the fact that unwinding would be uncertain, which was a negative. And the other is the other side. It could be inflationary. What I think we have seen is the first risk. The economy has not performed very well. It's been disappointing by every measure until very recently, and that's good.
That's not.
That is why the inflation rate has been so tame. It's a very weak economy. But we still, just to finish the answer, we still risk inflation. If the Fed is unable to unwind, lots of people out there saying they're behind the curve already, it is still a risk. And I say, that letter, which I signed on to, raised a lot of issues about the dangers of these kinds of policies, and I think to a great deal that those dangers have been realized.
But not inflation, you'd agree?
Well, look, you have an unusual policy which creates many kinds of risks. Probably the greatest concern is the slow economy and the fact that unemployment took so long to get down. Well, that is to me a tragedy. We not only had a deep recession, we've had an abysmally slow recovery. I don't think that's a good reflection on that policy.
Well, it's a question of what the alternatives are. If you believe that doing something that would increase the output gap would actually have made the economy healthier, then that's a discussion that probably is also worth having. Next, Dr. Calabria.
So first of all, I would say I'm not only concerned about certainly headline inflation, I'm concerned about asset prices. It's very unusual to have a financial crisis without some sort of run-up in asset prices. We could have had, you and I would have had the same conversation 10 years ago, and we would have missed the financial crisis. We would have missed the housing bubble. So quite frankly, I do think we need to be worried about asset prices. I also think we need to be worried about, the Fed paying interest on reserves for years has been contractionary. Why are we paying banks to have trillions of dollars sitting on the sidelines doing nothing? So I do think that sometimes the conversations sound like that the Fed is either purely expansionary, purely contractionary. I think the Fed is a bit schizophrenic right now, quite frankly. I think they're doing things that are contractionary. I think they're doing things that are expansionary. And the net effect has been a big fixed one. So certainly, I just don't think they've had a consistent set of policies. And certainly,
I'm trying to count sentences here.
Okay, well,
no, I understand. Yeah.
As you know, the two-armed economist bit with Truman, so that's the same here on one hand and the other.
Okay, Ms. Pierce.
So just with the caveat that I'm not an economist, I am concerned about the Fed's policies, buying mortgage-backed securities, for example. They're having a big impact on the market. And then something that Mr. Campbell alluded to earlier, which is that watching the markets react to whatever the Fed says is pretty disturbing. I think it would be much better if the market were reacting to the market.
Dr. Johnson.
Mr. Foster, good question. I think this quantitative easing was risky. It certainly has not produced inflation. There were legitimate concerns about that, but it hasn't. It also hasn't miraculously pulled us out of this hole created by the massive financial crisis. I think there's a limit to the magic that central banks can work in this kind of situation. I do think, though, the question is a good one, because imagine under the proposed legislation, you're going to be having hearings on a weekly or at least monthly basis all along exactly this lines with teams of experts like this, all disagreeing. You're all going to be disagreeing. Some of you are experts, some of you perhaps less expert. This is not particularly going to be helpful to the Federal Reserve trying to do its job. You should be asking questions about who gets appointed to the Federal Reserve, what are their qualifications. I don't have a problem with Mr. Calabria's suggestion that you can't put people on the Fed who've been working in the executive branch. I think that would rule out McChesney, Martin, Burns, Volcker, and Greenspan. But of the current board, only Lael Brainerd, I think. So those are legitimate questions.
In my 25 seconds left, if I could just have a quick yes or no, do you think that the Federal Reserve should have a larger role and a larger part of its thought process in trying to limit asset price bubbles, in particular real estate? You can see other countries have done this with some success, and do you think that should be an increased part of their portfolio or not? We just find out.
So I think the first thing the Fed can do about asset bubbles is to have a policy of interest rates and monetary policy that doesn't bring them on. I really mean that.
Okay.
A lot of the actions that have been taken recently by countries have focused, say, on bubbles and housing, have been because their interest rates are low. Take Switzerland. They have to have a low interest rate. They attack the housing market with other mechanisms. Take Singapore. They have the zero rate because the Fed has a zero rate. They have to take special actions to contain the bubble in their housing and automobile markets. So far they're kind of responding to the fact that monetary policy is stuck and not doing its usual thing. And I think the first thing to do is to make sure the central banks, our central bank in particular, don't cause the bubbles and then worry about what to do with it.
Time of the gentleman has expired. Chair now recognizes the gentleman from Texas, Mr. Nagelbauer, Chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Thank you for holding this hearing, and thank our panelists for being here. I really want to talk about Section 9 of the FRACT Act, which talks about international negotiations. One of the things that this committee has had a number of oversight hearings basically on the negotiations that are going on of FSOC and then also the discussions that are going on with the Financial Stability Board. As you know, in 2008, the G20 tasked the Financial Stability Board to come up with reforms for the financial system across the board internationally. And since then, it's been kind of interesting. Initially, the Financial Stability Board, I put a number of insurance companies and financial institutions as SIFIs. And subsequent to that, the FSOC made AIG and then Prudential as SIFIs. And so the question arises is because the fact that the SEC and the Fed and the Treasury are all participants in the Financial Stability Board. And so if they're over there in those negotiations and they vote then in those discussions to make these financial institutions financially significant institutions, and then they come back, do they have a fresh start then to determine from an SSOC standpoint whether they're going to be determined to be SIFIs? My question is, a scholar, Peter Walton with AEI, said something it's inconceivable that these designations of these three insurers would have gotten through a Financial Stability Board without expressed approval of the Fed and the Treasury. So is that distorting the procedure that they're over there voting at the Financial Stability Board, and then they're coming back and saying, okay, we're going to start over with a fresh piece of paper here and make our own determination? Or is the Financial Stability Board basically making these decisions, and are the Fed and the Treasury complicit to that? Dr. Taylor, you have an opinion on that?
So I don't know the specifics of your question, but I do know quite a bit about negotiating because I was Undersecretary of Treasury for International Affairs for 4+ years. My sense is there's frequently negotiating within the government, and then there's no negotiating between governments. And the within government, I think, as much as possible, should take the Congress into account. Doesn't always do that. I remember having former Chairman Barney Frank up to lunch at the Treasury to explain various things that we were working on at the time. I think that was essential. And so I think when you think about this legislation, the word negotiation, you have to think about what that means, and I think try to explain it more. But I think in the case you're talking about, it would be one where there should be some better consultation in the first place. But you're always going to have different opinion in different agencies. Some may be more worried about the economics. Some may be more worried about the security. Some may be more worried about U.S. competition, the competitiveness. And so they're going to figure out the best way and then approach the other government, which also has the different agencies. So it's a complicated process. I think the intent of the legislation, proposed legislation, is fine, but the word negotiation, I think, needs some more specificity.
Well, and I think one of the things that a lot of people feel like in the reason to have more transparency and disclosure here about what is going on in these negotiations is because basically it appears that those negotiations are ending up setting policy in our own country, and I think there's concern about that. And so much like if we're negotiating treaties between other countries, but basically we're in some ways negotiating treaties between financial institutions. Dr. Calabria, you seem to want to engage.
I certainly share that concern. Let me make a broader point about much of this, and this applies to the cost benefit. This applies to the negotiation. Congress can decide all this stuff if it wants. Remember, within Dodd-Frank, we've decided that bank holding companies. I mean, there's no negotiation there. Boom, you're in. You could have decided that. The Congress could have set up other parameters. So any of these efforts, to me, part of the problem is that Dodd-Frank has 400-some rulemakings. There's just so much delegation, so much discretion in the regulatory process that I think some of these hard choices actually have to be made up here rather than by the regulators. But I certainly do agree. I worry that the FSOC, the SIFI process, that in my opinion we are essentially signaling to the market that these are too big to fail. I worry that is committing the Fed to assisting those entities. So I certainly think that needs to be a more transparent process.
I see my time has expired.
Chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
I agree with Dr. Calabrera that Dodd-Frank basically just transferred all this power to the executive branch. It took us 2,000 pages to just say, the executive branch, don't let it happen again, and here are all the hammers to use to make that happen. Hit whoever ought to be hit. But all too often, we either do nothing or we can't agree on what to do, so we just empower the executive branch. I don't always agree with the Fed. They haven't focused on the trade deficit. Of course, virtually no one in Washington talks about the trade deficit. And they haven't agreed with Bernie Sanders and I that too big to fail is too big to exist. But very few people in Washington agree with Bernie Sanders and I on that point. But the Fed has done more than any other institution to pull us out of the Great Recession. They have not debased our currency. It's, if anything, as shown by the inflation rate, the cost of living index, as valuable as anyone would have predicted that it would be in 2014. We've had a slow recovery, but we had a national financial meltdown, and when that happens, you expect a slow recovery, but I don't think you blame the slow recovery on Fed policy. Their low interest rates are the only thing that has pulled us, any policy that I can point to in the last several years that have pulled us out of this recession. And we should approach things with a degree of humility, because I don't think there's anybody in this room that can wave around a brokerage receipt showing that they were selling countrywide short in early 2008. If anybody really knew and was ready to bet the farm that 2008 would have happened, at least they could do is give me a ride on their private jet, subject to Ethics Committee approval. The gentleman from New Jersey says that cost-benefit analysis was endorsed by President Clinton and President Obama. I do think I need to point out for the record, they never supported a cost-benefit analysis for Fed monetary policy decisions, because everything they do is a cost-benefit analysis. It isn't trying to weigh deaths from pollution to effects on the economy. Everything they do is to focus on the national economy. So let's there are various co-sponsors of the FRAT Act. Presidents Clinton and Obama should not be listed. Dr. Calabria, you've suggested that we not allow people who've served in the executive branch within the last 5 years to serve on the Fed. Should we have the same rule for those who have worked on Wall Street?
In terms of people at Wall Street working on the Fed?
Yeah.
Yeah, I would be fine with a 4-year. I think that that's a reasonable ban. Let me say, as an aside, I was.
So we would have just academics on the Fed.
No, because
having excluded the executive and former members of Congress.
If I could channel Section 10,
if
I can channel Section 10 of the Federal Reserve Act a second, it does say due representation to agriculture, commerce, and industry. So it actually, the Federal Reserve Act, as structured, suggests that we should have people, not just academics, not just bankers.
Yeah, I would point out there are two major problems with the structure of the Fed. One, it's undemocratic. You have governmental power in the hands of those elected by bankers. And second, it discriminates against the western half of the country. Certainly, if you have the San Francisco Fed representing 3 or 4 times as many people as the New York Fed, at least you could do is give the San Francisco Fed a permanent seat on the Open Market Committee. But perhaps I could work with the gentleman from New Jersey to correct those two problems. So, Mr. Calabria.
I suggested in my testimony, Section 10 of the Federal Reserve Act also requires that no 2 members of the board can be from the same Federal Reserve District. We have repeatedly violated that. I would go as far to say that with the current makeup of the board, and you count the New York, that the New York District has 6 votes on the FOMC.
And the board that represents 3 or 4 times as many people as any other board has either 1 or 0 and no assurance of even 1. Finally, there's this idea, Dr. Johnson, that we could write a rule and then put monetary policy on automatic pilot if we just wrote a good rule. Is that possible?
Time of the gentleman has expired.
The gentleman said no.
Recognizes the gentleman from Missouri, Mr. Lukemeyer, Vice Chairman of the Housing and Insurance Subcommittee, for 5 minutes.
Thank you, Mr. Chairman. I want to go to the section that deals with the stress test of the banks. And this really concerns me. I know that Sheila Bair wrote an op-ed back in 2013, April, that the headline was, "Regulators Let Big Banks Look Safer Than They Are." And in there, she makes the comment that the ease with which models can be manipulated results in a widely divergent risk weightings among banks with similar portfolios. Ironically, the government permits the banks to use its own internal models to determine the riskiness of assets such as securities and derivatives, which are held for trading, but not to determine the riskiness of good old-fashioned loans. The risk weights of the loans are determined by regulation and generally subject to tougher capital treatment. As a result, financial institutions with large trading books can have less capital and still report higher ratios with traditional banks whose portfolios consist primarily of loans. And she goes on to give an example of a big bank that's got 14% capital, yet if you take the risk weighting out, it goes down to 7. And then a big regional bank that's risk rated at 9, and if you take the risk weighting out, it stays almost the same. So we're playing on two different fields here, and I think this part of the bill is extremely important from the standpoint of how you begin to, I think, get some of these big banks under control. If you let them write their own stress test, if you let them write their own rules for how they exist, how in the world can we actually find a way to regulate those? And Dr. Clyburn, I know you mentioned this in your testimony. Can you?
You know, I mean, I want to repeat something that Professor Johnson said, which is the stress tests are gamed, and I think the difference is, and maybe we will agree or disagree on this. I think they're always going to be gamed. I think the Basel capital courts have been gamed. I think you see these herding into low-risk assets. I mean, let's not forget the experts told us that Greek debt was risk-free ahead of the crisis. I think that was obviously not the case. I really think we should abandon the stress tests, abandon the Basel capital courts, and go to a flat, clear leverage ratio. And I think that that's far more simplistic and far more transparent.
Okay, you don't believe that the weighting of the riskiness of the assets is,
I mean,
is something to be taken into consideration here?
There's always going to be that issue, but I have yet to know of any financial crisis caused by small business lending. Yet we know that small business is risky. We also know that the Basel capital courts and the stress test dissuade banks from doing small business lending. I think it's far more important to have a diversity of portfolios, which to me the stress tests and the capital accords encourage homogeneity in a way that to me becomes systemic.
Okay, along that line, what this bill does, though, is increase the transparency of those tests so that at least the general public.
It's a small step in the right direction.
Okay, well, that's where I was trying to go with. Yes, Dr. Johnson. You talk faster than I think, so can you slow down real quickly?
Okay. So I am sensitive that you have limited time. I and Mr. Calabria agree on the capital part, and I think we're agreeing with you, and I think you're making a very important point, which is we should be putting more emphasis on the leverage ratio, which is assessment of capital without these funky risk weights, and less emphasis on the risk-weighted. I'm not saying zero, but less emphasis. I think we completely agree on that. I think you're also right, and Sheila Bair is right, to have concerns about anything that allows the banks to use their own models, because they put all kinds of crazy stuff in that, and it's not subject to very good supervision. The stress test proposal in this legislation, I'm afraid I disagree with Mr. Clyburn. I think it's a small step in the wrong direction. I think you're making it easier for the banks to game the stress tests. I agree the stress tests are not...
You don't believe the transparency helps in this regard? I mean, that's basically what this does here. It adds to transparency.
What you have right now, Congressman, is you have transparency on the criteria for the stress test, how stressed, what's going to go wrong in the stress scenario. What the banks want to see is the details of the models that the Fed is using. Once they have those models and they run those models on their own computers, they can game them just like they game their own models. That's what you don't want. So we're agreeing on the capital, though, and I agree with you what you said at the beginning. Capital is the most important thing. Capital should be front and center, and capital without the funky risk weights is the way to go.
Okay, so how would you structure that then? Just, Dr. Clyburn, you just indicated you just have a...
So I was going to say we do agree that it's a small step, at least with the direction we might disagree on. But, again, I do think that getting more of the assumptions out there and the parameters, and I would agree. I mean, I think internal bank risk models are fine for the banks, but you can't use them for regulatory purposes, and I think that has to be the question here.
Because this really concerns me, because I think what we're doing is we're giving the general public a level of
I think it's a false confidence.
A level of confidence that the system is going fine, everything is good. But when you look at what's really happening here, they are gaming the system, and I think it's really unfortunate, because I don't think the American public has the true picture. With that, I yield back. Thank you, Mr. Chairman.
Time of the gentleman has expired. I'll recognize the gentleman from California briefly for unanimous consent.
I ask unanimous consent to put in the record Executive Order 12-866 and Section 10 thereof.
Without objection.
Which states that
without objection.
No judicial review is allowed of this executive order.
For the unanimous consent decree, not for the pontification. The chair now recognizes the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chair, and thanks to all the witnesses for giving of your time today. Dr. Johnson, I note with some interest that the proposed legislation effectively reasserts the dual mission of the Fed, namely bringing about price stability and optimal employment levels. I'm wondering, frankly, if that would be its practical effect. I'm looking back over the last 4 years as an example, and have seen where inarguably the Fed's policies have contributed to a decline in the unemployment rate from 9 to 6%. And noted with interest, as revealed, I think, in Congresswoman Capito's question, application of this legislation would have inarguably increased interest rates over that same 4-year period of time. What's your analysis as to what would have occurred unemployment level wise had there been higher interest rates?
Well, if the Fed hadn't taken the broad set of extraordinary measures that they embarked on in 2008, including lowering interest rates and also buying assets in a way that was at that point considered unconventional and affecting different kinds of interest rates other than the short-term traditional policy rate, then the recession would have been deeper and unemployment would have stayed higher for longer and the recovery would have been slower. I think that is, unfortunately, what would have happened and what would happen in a future crisis if it is the case, as I believe it is, that this legislation would effectively limit the ability of the Fed to respond fully.
So, confirming my worst fear and suspicion that it would have increased unemployment, notwithstanding the fact that it reasserts that dual mission, there are actually other bills before the Congress that have been proposed that would have eliminated the secondary mission of optimal employment levels, which is a something like 40-year-old law on the books passed by the then House Banking Committee, overwhelmingly, 3 dissenting votes in the United States House of Representatives. It was a bipartisan bill to set the second mission of optimal employment. If we were to remove the optimal employment mission from the Fed, and if it were in fact to focus exclusively on price stability, what's your opinion and analysis as to how that would play out if they were in effect not allowed to consider unemployment levels but only price stability?
So it depends on how they would interpret that, and there are some central banks around the world, for example, the European Central Bank, that does focus by law exclusively on price stability. I think you would have less response in the case of these big downturns, certainly the financial crisis type situations. I don't think the Fed would embark on the same sort of creative and unconventional policies. I don't think you'd have the same kind of interest rate cuts. I think you'd have higher unemployment in those situations.
So last question, if I may. Various members of this committee tend to focus on those two issues and economic indicators, price stability, employment levels. I like them too. But for the last couple of years, I've frankly been kind of fascinated by the output gap as an indicator. In fact, while I clearly have a problem with how it's applied in this instance, the fact that the output gap is a part of this formula, I think is interesting. And I'm wondering from your perspective, as somebody who doesn't like the approach taken in this bill, is there a way, are there policy approaches that we could take that would utilize to a greater degree the output gap as a means of driving policy? And just to remind everybody, that's the difference between actual and potential, which is essentially a no-cost deficit to be made up in terms of the strength of the economic output, if I can use lay terms to describe it.
It's a good question and a completely accurate formulation. Look, the experts disagree a lot about this, about precisely how big is the output gap. You have to take a view on what's happened to labor force participation, as I'm sure you're well aware, Congressman. And I think this is a perfect example of why you need to delegate decision-making to the Federal Reserve. I don't think a legislative body or a committee hearing like this produces an operational answer that stands up over time. I think you need to put the right people on your decision-making board, the FOMC in this case. They need to have this argument. They need to have a large staff of experts, as Mr. Hensling has said, who need to be well-trained in a wide range of economic methodologies. And they need to hammer it out, and then they need to be held accountable, as they are in their regular hearings with you. That's the way to get at a question like that.
Thank you, sir.
Time of the gentleman has expired. The chair now recognizes the gentleman from Ohio, Mr. Stivers.
Thank you, Mr. Chairman. I appreciate your time. I want to thank the witnesses for being here and for your testimony. And first, I want to give Dr. Taylor a chance to correct the record on the comments of the gentleman from California, who I believe a few minutes ago said that Section 7 of the bill, the cost-benefit analysis section, would require the Free Market Open Committee to perform cost-benefit analysis on monetary policy. And I direct Dr. Taylor to page 15, line 8, which says, before issuing any regulation, comma, does that mean they'd have to consider a cost-benefit analysis on monetary policy?
It's pretty clearly, it's addressed to regulatory policy, in my view. And quite frankly, this discussion about cost-benefit analysis is amazing to me. It's the sort of the basic thing you teach students about government policy. You have to pass a cost-benefit test. And yes, it's hard. Yes, it's difficult. But why would you just abandon it? It makes no sense to me, really.
Well, thank you. And that's the way I read it, too. But the way I read Obamacare, it was bad, too. So maybe different people read it differently. But I appreciate that clarification, because I think that is really important to note. It's about the regulatory authority, and the Federal Reserve is a giant regulator in addition to the monetary policy that they pass. So I think that's really important on the cost-benefit analysis. And in fact, the President has an executive order on cost-benefit analysis that he signed. It just can't apply to independent agencies like the Federal Reserve. Therefore, an act like this is very important. So I want to thank Mr. Huizenga and the gentleman from New Jersey for their work on it. Second, I guess on Section 5, and I'll open this up to the entire panel, is there anyone that believes that a quarterly testimony of the Federal Reserve before Congress is overly burdensome on the Federal Reserve? So there's one. I will take that as 3 people do not think it's overly burdensome, and 1 person does. I would just say, if we're going to have transparency in this country, having somebody be here for a few minutes every 90 days is not too much to ask. And transparency is really important, and I think this can really help. I think there's been a lot of conversation already from previous questions on Section 2 of the bill that deals with moving to a more rule-based system. I think I would like to ask Dr. Taylor if he wants to, if he remembers or wants to talk about the day when Chairman Bernanke said we might just stop quantitative easing, and what happened to the markets. Do you remember what happened that morning?
Yes, it was in the Joint Economic Committee, I believe. He said maybe in the next few meetings there'll be a decision, and that the sometimes called the taper tantrum, and it did cause a lot of volatility, to say for sure. In fact, quantitative easing 3, it started when the long-term Treasury, 10-year Treasury was 1.7, and when he stopped talking, it was 2.7. So it's hard to see that that had a positive effect on lower rates.
Right.
There's a lot of mistaken views about this. For one, I just say the notion that unemployment would be higher if this legislation was passed, I believe that's completely wrong. You wouldn't have had nearly the crisis that you had, I believe, or the recession. And that's what's, to me, a tragedy, that we went through all this, and it's been a slow recovery. And, you know, there isn't any day that say recoveries have to be slow after deep recessions. That's not American history. We have faster recoveries after deep recessions in this country. This is the most unusual slow recovery from a deep recession that we've ever had in our history that we can record. So those are the facts.
Thank you. I would like to give Dr. Calabria and Dr. Pierce a chance to talk on Section 9 really quickly. Section 9 deals with transparency on international negotiations, and as international harmonization becomes a bigger issue, don't you think the American public deserves to know the positions that their regulators are taking on their behalf in these international negotiations? Either one of you.
I certainly think that's important, given the role that the international negotiations are playing in determining what's happening here domestically. Obviously, you can define negotiations so that normal conversations can happen between regulators, but for the major issues, there should be some input from the public here before positions are taken abroad.
Time of the gentleman has expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Mr. Chairman. A couple different things. Mr. Johnson, before I get on to the questions that I wanted to ask, you mentioned something that caught my attention several questioners back regarding some comments that Mr. John Allison at the Cato Institute, formerly of BB&T, had made regarding a suggestion he had on raising capital requirements to roughly 20%. In my conversations with him on the same topic, he mentioned the same thing to me, but were you aware, or was it your understanding, as it was mine in my conversations with Mr. Allison, that that was part of a larger proposal that it would allow an alternative system, that banks could opt out of Dodd-Frank, opt out of the oversight that they have today, the regulatory climate they have, and opt into a new parallel system where the primary, if not the only requirement, was this 20% capital requirement. Was that your understanding, sir?
I think I should let Mr. Calabria answer that. I just read one article. I didn't get that impression from the article. I defer to Mr. Calabria.
That is correct. It's not an add-on to the existing system. It is a much newer, simpler, and what I believe would be a safer system.
Yeah, and then I won't ask you, Mr. Johnson, if you're not that familiar with it, what your opinion is of it, but it might be interesting to have that conversation at some future hearing about whether or not the idea of a parallel system, you can either maintain your lower capital requirements and operate within the existing system, or opt into a parallel system that has a much more limited regulatory climate, but a much larger capital requirement. We'll deal with that another time. Dr. Taylor, over the course of the last 2 years here, I've had a chance to talk to both Mr. Bernanke and then subsequently his successor, Mrs. Yellen, regarding the monetary tools that might be available and might not be available to the Fed as they go forward in an era of rising interest rates environments. And the conversation we have usually focuses on the difficulties they might have in absorbing huge balance sheet losses if they have to sell securities. And the answer I got in response to that inquiry from both Mr. Bernanke and Ms. Yellen was that the Fed could avoid having to book these losses by participating in the repurchase, in the repo market. Subsequent to the first conversations we had in this committee about that, the Fed actually did it, or at least started that. They created last September the overnight reverse repurchase facility. This committee received a letter last week, June 30th, from Ms. Sheila Bair, the former head of the FDIC. I ask unanimous consent to go into the record.
Without objection.
And she's got concerns about it, a lot of different concerns about it, not the least of which is whether or not it would essentially force short-term investors to reallocate their investment dollars given the presence of this new super safe investment. Would the Fed go from essentially being the lender of last resort to the borrower of first resort? The size of this market has grown very dramatically, very quickly, and in the 2 minutes I've got left, Dr. Taylor, I'd ask you if you have some opinions on whether or not the Fed should be doing this, and whether the Fed should be coming to Congress to ask for the ability to do this.
My view is, as long as this balance sheet is so large that they have to do something when they want to raise interest rates. They are perfectly capable of raising interest on reserves for this interval, and I think that would be fine. They're doing these other things because during the panic, they saw that the federal funds rate actually went below the interest on reserves, and so they're concerned that they need to do both of these things: repos, reverse repos, and interest on reserves. But my main concern about either of these is it leads to a situation where the balance sheet may be permanently high, basically forever. Call it QE forever, and the interest rate will be moved around either by reverse repo or interest on reserves. I think that's quite problematic. I would like to see the Fed return to a situation where the supply and demand for reserves determines that short-term interest rate. Then you won't have all the quantitative easing possibilities that you've had currently. And of course, to move there more quickly, it would mean they may have to sell off some of this large balance sheet. And I think if they do that in a strategic, clear way, like the second part of tapering has been, I think it wouldn't be a problem for the markets. So I have a lot of concerns with this policy where they're going to go, because frequently in policy, in my experience, is you start out something temporary, like temporary 3 or 4 or 5 years with this balance sheet so big, and it becomes a permanent one. And it's a real concern to me that the future will be QE forever.
Dr. Clabber, you look like you had some thoughts.
I was just going to say that I very much agree. I mean, I think the Fed's going to have to look at some ways to get out of this, and I think they need some flexibility in that. And the broader point should have been, I think they need to remember why central banks generally stay out of the long end of the yield curve to begin with. But you're in this mess now.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger, for 5 minutes. Would the gentleman yield to the chair briefly?
Yes, sir.
It's come up a couple of times. I believe one member of the panel has said it is overly burdensome for the Fed chair to meet with Congress on a quarterly basis. It has been well established in the press that the Fed chair meets with the Secretary of Treasury on a weekly basis. Is there any member of the panel who believes it is more burdensome to meet with Congress on a quarterly basis than with the executive branch on a weekly basis? Please raise your hand. I see one. I yield back to the gentleman from North Carolina.
Thank you, Mr. Chairman. Dr. Taylor, it often seems that any time Congress is contemplating an amendment to the Federal Reserve Act regarding the Fed's monetary policy requirements, that we hear a knee-jerk response that will threaten the Fed's independence. Do you feel that this is the case at this time?
I think the legislation is crafted very well to prevent that, and indeed the Fed chooses its own policy rule, and so it has the operational independence that it needs. I think you need to go beyond the independence, and that's why I think this legislation is so valuable.
Thank you. Ms. Peirce, do you believe that putting the economic analysis requirement into the statute like we have at the SEC and the CFTC can have a beneficial effect on the rulemaking process and result in sounder regulatory outcomes?
Absolutely. I think that the SEC has been through its own process of first ignoring its requirement, then being reminded that it should adhere to that, and then starting to employ that. And I think we're gradually seeing improved rules as a result and more deliberate rulemaking, and that's definitely needed at the Fed.
Thank you. The SEC has rules in place to ensure that employees and officials do not trade on information that they learn on the job and require them to disclose their financial investments. Do you believe that the Federal Reserve should be exempt from these requirements, despite the fact that the Fed employees have access to sensitive, potentially market-moving information? We'll start with you, Mr. Johnson.
Congressman, I had a chance to review the rules, the detailed rules, and I think the Fed circulated them more broadly, comparing the restrictions on their staff with the restrictions on the SEC. Their wording is slightly different because they have obviously different jurisdictions, but it seemed to me to be almost exactly parallel in terms of what they can and cannot do. And so I didn't understand that part of the legislation. I don't understand the problem that you're trying to fix there, because it seems like the Fed does have exactly the right kind of rules already. But tell me what I'm missing.
Mr. Cleary, would you like to respond to that?
Well, it seems like what you're simply doing is putting current Fed practice into statute. And that's great that they're doing it now. There's no guarantee they'll continue to do it. So I don't see much harm. Again, maybe I should use the phrase small step here, because, again, it's a small step in the right direction.
Sure, Dr. Taylor?
Agree with that.
Pardon?
Just,
Ms. Peirce, did you want to respond?
Yeah, I wanted to note that part of the problem is the Fed's lack of transparency, and I think this illustrates it. If they have great procedures, they could tell Congress about them and get them baked into the bill.
They did tell you about them. I think those details have been available for a long time. I don't understand what's the lack of transparency around these restrictions, these practices. I think they are available to Congress. I think they're available to this chair of the committee any moment of any day that he wants to pick up the phone and call them.
I think the problem is that the Fed's practice has been, and perhaps this is grounded in the fact that it was primarily established for monetary policy, but the practice has been to not be transparent. And so that's the pushback that Congress needs to give, because the Fed can't, it's now a massive regulator, and it can't hide behind the traditions it's built up in its monetary policy realm.
Thank you. Ms. Peirce, I would like to ask, the FRAD Act requires the Fed to provide metrics by which to gauge the success of a proposed rule. It requires the Fed to subsequently use those metrics to judge whether the rule has achieved its purpose. Do you believe that will help to ensure new rules accomplish their intended purpose?
I think that's a very important thing to do. It's important for the agency to set forth the metrics by which it will measure its own success, and then a few years later to go back. Otherwise, what it will do is, when it does the retrospective review, it'll just pick metrics that work well for it. So it facilitates an honest review.
Dr. Kleber, do you want to? Seemed like you had something on your mind.
I do think that's helpful. I'd also add that, I think that applies across the board. So my certainly general suggestion should be everything within this committee's jurisdiction should be subject to a regular sunset, so that you were forced to reevaluate it.
Thank you. Yield back my time.
Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman.
Dr. Taylor, markets responded forcefully to one of the first FOMC meeting releases to be accompanied by a press conference last summer. This panicked response occurred despite Chairman Bernanke's characterization of his comments as not substantially altering the FOMC's policy stance. A recent survey of 55 economists by the Wall Street Journal gave the Fed a grade of D- for its guidance. Don't these facts show that the Fed's monetary policy guidance function needs more work?
I think so. I think the forward guidance as practiced has changed quite a bit. It's been erratic. I would go back to the point if they had a policy rule like this legislation is asking, that the forward guidance would just fall out automatically. There would not be much of a question about it.
Yeah, I'd like to follow up on this distinction we've been talking a little bit about between the Fed's role in setting monetary policy and the Fed's role as a separate role as a financial regulator. Dr. Calabria, we hear many times about the importance of the Fed's independence. Does this argument about the Fed's independence apply to the Fed's regulatory responsibilities as well as its monetary policy responsibilities?
You know, I don't think it does, and as I alluded to in my testimony, I mean, I think the fact that the Fed does bank regulation undermines its ability to conduct independent monetary policy and certainly represents some conflicts of interest. You know, the Greenspan put, Bernanke put, and maybe pretty soon we'll call it the Yellen put, you know, came about because of the responsibility of the Fed feeling like they needed to rescue financial institutions every time there was a market hiccup. And I would certainly argue that some of the rescues, you know, particularly of AIG, were done partly to cover up mistakes on the regulatory side that the New York Fed made. So to me, I just think there's a real tension here in having this entity be a central bank and a financial regulator.
As a financial regulator, should the Federal Reserve be any more independent of congressional oversight than other financial regulators such as the OCC or the FDIC?
No.
Do any of the accountability and transparency provisions in this legislation threaten the Fed's independence to set monetary policy?
In my view, no. You know, let me add, it's often, you know, I think the traditional view is felt that if we give a regulator discretion, that you know, entails you know, independence. And I can certainly say, as having been a regulator for a short amount of time, you get all sorts of pressure, and it's much easier to be independent if you have a set of rules to hide behind. So you can sit here and say, well, we'd love to do that for you, but this is what the law actually says. And so we've certainly seen this. I mean, one of the reasons that the Volcker Rule has become so convoluted is because it wasn't very clear to begin with. And so if you've got a clear set of rules and statute, it's much easier for the regulator to defend that and stick with that than it is to compromise along the way.
Ms. Peirce, does Fed independence in setting monetary policy mean the Fed's financial regulations are above the law?
No, absolutely not. I think it's very important that if the Fed is going to be a regulator, and I would agree with Dr. Calabria that it should not be, but if it's going to be a big regulator, it needs to be subject to the same accountability as other regulators are.
I'd like to talk a little bit about the Fed's stress test program, Ms. Peirce. The Fed's stress test program attempts to gauge how bank balance sheets hold up in worst-case scenarios to ensure banks are prepared for periods of extended financial stress. But wouldn't it be appropriate to also require the Fed to stress test its own accommodative monetary policy? Specifically, shouldn't the Fed be required to stress test its exit strategy to its quantitative easing program to estimate the effect on the Fed's ability to fulfill its mandate, the impact on the Fed's balance sheet, the upper ranges of interest on excess reserves the Fed might be required to pay, and how increases in the federal funds rate might impact the relationship between the government's interest payments on Treasury obligations and the deficit?
I'm going to defer to Dr. Taylor on that, since I think he has a better sense of.
Well, I think that all those things the Fed should do. And the evidence that they put out now that quantitative easing worked, I think, is based on studies that just look at the announcement effect. They're not that great. They're wrong in my view. But so I think that in some sense the answer to your question is to have these studies be done, made them public, so we can question them and analyze them and have a better debate about it. I think when you say require them to do a specific kind of study or a specific kind of analysis, I would say that should come out of.
Well, I guess that leads to another question. Should the Fed be subject to transparency requirements for its own stress test models and results?
No, I think if this legislation is to work well, the Fed is going to make those things clear. That will be an example of a deviation from a policy rule. And so they're going to have to explain why they did that. So I think it would come out of the testimony. I would hope that they'd say, well, we're going to deviate because of X, and they'll make it clear their analysis, and you being informed about it will be able to question that, and it'll be a public debate. So I very much feel that a lot of the things that they've done recently have not been productive. They've gone ahead with them, but they've been deviations from the kind of policy this legislation would ask for.
Time of the gentleman has expired. Chair now recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman, for holding this very important hearing, and thank you to the panelists. It has been argued that there could not have been a housing bubble or the massive misinvestment in the housing market in the run-up to the financial crisis had the Fed not made the decision to expand the money supply to the extent that it did to finance the bubble in the run-up to the crisis. The proponents of this argument make the case that the fundamental cause of the crisis was mistakes by the Fed. In other words, that it would have been impossible for a misallocation or a misinvestment of this scale to have occurred without the monetary policies pursued by the Fed before 2008. Do the panelists agree that the Federal Reserve had a role to play in causing the financial crisis? And we'll just go down the row.
Yes, I do. I think that was, I would characterize it as they held interest rates too low for too long in that period, and that caused excesses in the housing market, search for yield. I'd say there's regulatory issues as well. There's rules on safety and soundness were not adhered to enough. So it's kind of breaking two kinds of rules that I think led to the crisis.
Okay.
So I would say as well that I absolutely think that monetary policy conducted about a decade ago, if you will, was a contributor of many. And to repeat what Dr. Taylor said, there certainly were other regulatory failings, some of those by the Federal Reserve as well. For instance, to me, I think the Basel Capital Accords were a very big contributor to the crisis. But again, there's not a monocausal definition of the crisis. To me, a dozen different explanations that all had some bearing, but I absolutely do believe monetary policy was a very big contributor, that if we had followed something like a Taylor rule, the boom size of the housing market would have been a lot smaller.
And just coming from my perspective, I would say that the Fed's regulatory policy did play a role, and that's why it's so surprising that their regulatory powers were expanded in Dodd-Frank.
To answer your question, Congressman, the monetary policy did contribute, but in a relatively small way. The regulatory failures were much more profound. They were not just at the Federal Reserve. They were throughout the regulatory system. They were also on Capitol Hill. And to the points been made previously, central banks that did not have regulatory functions also struggled, and those economies also struggled, as in Britain, as in Europe, with similar problems. So the regulatory failure was not because the regulations were at the central bank. They were a much broader misunderstanding of what the system needed.
Okay, and I think, Dr. Calabria, you answered this question in your initial, but the follow-up here is that to the extent monetary policy, not the regulatory side, but monetary policy was a contributing factor, was the Federal Reserve following a rule-based approach in conducting monetary policy in the years leading up to the financial crisis, or following a more unpredictable model and an ad hoc monetary policy?
I certainly think in the years 2003 to about 2005, 2002 to 2005, there were large deviations from what would have been a rule, and monetary policy was certainly looser than they would have otherwise. But I do want to repeat what Professor Johnson said. Certainly there were regulatory failings across the system, as well as I spent my time up here, and I can certainly say there were failings up here.
Professor Johnson made the argument that that legislation before this committee is monetary policy by Spanish Inquisition, that the legislation would produce volatility as opposed to prevent volatility. I would just ask, what produces a greater risk of volatility, a GAO audit of the Fed's conduct of monetary policy that deviates from a reference rule, or the opaque process that led up to the financial crisis, which was characterized by a monetary policy untethered to any predictable rule day by day based on the whims of the Open Market Committee. Let me just, that's a hypothetical question, let me just take the remaining time to ask a question to to Dr. Peirce really quickly on the regulatory policies of the Federal Reserve. When we talk about applying cost-benefit analysis to the Federal Reserve, does it create a problem when the cost-benefit analysis requirements are applied to executive branch or independent agencies like the SEC or the CFTC, but do not apply to another prudential regulator in the form of the Fed?
It does create a problem. I think we saw that with the Volcker Rule, where the Fed didn't have to do an economic analysis, and so we got the Volcker Rule without an analysis. And I think that, across the board, the Fed is a very powerful regulator and needs to be contributing its analysis also.
Time of the gentleman has expired. Chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Dr. Simon, I appreciate the passion of your opening, and in your written opening, you indicate that everyone involved in designing and implementing monetary policy and financial regulation should ultimately be accountable, at least indirectly, to the electorate. My question to you, first of all, is how do you manage that? How do you make them even indirectly accountable to the electorate? Because I believe we all agree that accountability is important.
So, Congressman, the system, as you know far better than I, that's worked well for 200 years in the American Republic, is that you have the President nominate people subject to Senate confirmation, and then you have regular oversight hearings of various kinds. And that is what we do for the Board of Governors of the Federal Reserve System. It's not what we do for the presidents of the reserve banks. Now, that's a result of a very strange compromise that was negotiated for the 1913 Act, and it has become, I think, increasingly problematic. You're making some very good points about oversight, the need for oversight.
But there
is no oversight over the New York Fed.
It's created by congressional empowerment. It should have congressional oversight, period. I mean, you would agree with that?
Yes, it should, and it doesn't. I'm telling you, the reserve banks are not subject to accountability in the way that the Board of Governors is.
But
it's a big disconnect.
All that we're proposing here is just greater transparency. We're not saying substantively these are the rules.
Well, no. Here you're not addressing the main problem in the Federal Reserve System, which is the reserve banks.
Let me ask you this, because they do have an independent budget. I mean, they operate with what they're able to sustain off of their investments and whatnot. But how would requiring the Fed to publish the salaries of employees who are paid GS 15, which is $124,000 and higher, hinder that budget independence? I mean, wouldn't that just be good transparency to know that? I mean, ultimately, if there is any excess in the Fed, that money has to go back to the Treasury. So I think, again, being accountable and making sure that we're accounting for all those dollars so that the Treasury gets what they're entitled to, posting something like that wouldn't be a bad thing.
It's an interesting question. Are you going to require this also with the Reserve Bank? So you're going to require the salary disclosure of the executives of the New York Fed? Because they're not paid on the same scale.
Sir, I've only got 5 minutes. I don't
suffer
blank air that well. It makes me a little bit impatient. All I'm saying is, in this particular situation, why not have it disclosed?
I'm asking.
You're asking.
I'm asking.
You can't give me an answer. That's fine.
I'm asking in order to understand what you're proposing. If you're going to include the reserve banks.
This is my time, please, sir.
The time belongs to the gentleman from Florida.
I'm going to try to answer Professor Johnson's question, which is my read of the Act, where it says the Board of Governors of the Federal Reserve System. So I think you should broaden that. So to me, I think it's certainly fair to have that disclosure for the reserve banks. So I'm agreeing with you that they should add that. This is the tweak. That seems a reasonable approach to me.
Peirce, it seems that Dr. Simon believes that oversight, accountability, and independence are mutually exclusive. Do you agree with that?
No, I think that the framework set up where you let the folks at the Federal Reserve do their jobs, but they have to explain what they're doing to the Congress and the public and get feedback.
And explain how they're doing it and why they're doing it. And Dr. Simon, am I mischaracterizing your testimony that accountability and independence are mutually exclusive?
What I said in my first paragraph. No,
let me ask
Congressman, you mischaracterized my testimony.
Again, let me ask you this question.
Can I please answer the question?
If they have a policy for setting monetary policy that includes such things as the rate of inflation, GDP, and other factors, and that is good to have as a criteria, what is wrong with disclosing all criteria used in developing and implementing monetary policy?
Congressman, what's worked with regard to central banking in the past 100 years in this country and in other countries is to have the government, in this case Congress, stipulate what the objectives are. And it's up to you to determine the objectives.
Yes, it
if
is.
you don't like the employment objective,
That's what we're trying to do. We're just trying to make sure that we know what those objectives are that are being relied upon.
Sorry, Congressman, you're going way beyond. You're going way beyond what Congress has done in the past 100 years.
Again,
That's your prerogative, of course, but this is radical, new.
Dr. Taylor, real quickly, I've just got 40 seconds left. I understand that international coordination is necessary. I mean, we've got we live in a different environment than we have 10 years ago, 5 years ago in a global economy. But are you worried that the Federal Reserve may be prioritizing international stability over the domestic stability and regulation? I mean, with their involvement with FSOC, with involvement in international regulatory environment, are we discounting our domestic regulatory environment in lieu of trying to maintain or at least gain some international control or influence?
I think, to answer your question, Congressman, that the best thing that the Fed can do is have a monetary policy that's good for the U.S., and that is basically going to help the globe. I think to some extent right now the policy it's had has been disturbing globally. It's basically, even this so-called taper tantrum had impacts all over the world, and that comes back and hurts the U.S. So it does make sense to think about U.S. monetary policy as having effects abroad and worrying about those because they feed back onto the United States. I think it's very, very important.
Thank you, Dr. Taylor. I see my time has expired.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Holtgren.
Thank you, Mr. Chairman. Thank you all for being here. As we all know, in the wake of recent financial crises, the Federal Reserve has absolutely accumulated a vast amount of unprecedented power to oversee our economy. Its balance sheet alone has grown to a staggering $4.3 trillion, one-fifth of the economy, and it has also grappled with an expanded array of regulatory duties. My constituents demand that the Fed account for its handling of these important issues. It's just common sense. After all, Fed policy impacts every aspect of our Main Street economy, from the price of daily essentials like gas, milk, and bread, to the cost of a home and the strength of seniors' retirement savings. The Federal Reserve must remain an independent agency that can withstand political threats to that independence. But this bill does not tell the Fed when or how to do its job. It just requires that the Fed take a transparent, measured approach to doing so. An independent Fed shouldn't equal an opaque Fed. These sensible reforms could bring the accountability to the Federal Reserve that the American people demand, and I thank the committee for taking up this legislation. I want to focus in my question time to start with this stress test provision in the bill. Stress tests can be a very important way to show that large financial institutions can, in fact, withstand an economic downturn. This reduces the likelihood of future bailouts because they encourage companies to follow safe and sound business practices. They also convince our nation's policymakers that the proverbial sky will not fall during an economic downturn. However, I'm also deeply concerned about the highly secretive and unpredictable nature of the stress testing process. The Fed doesn't have to follow the notice and comment process. Too often focuses on unpredictable qualitative factors and doesn't provide banks with a detailed accounting of the stress test methodology. In practice, banks respond by constraining their lending, which hinders the economic recovery that my constituents desperately need. This legislation addresses those concerns. Some, such as our distinguished panelist, Dr. Johnson, worry that this legislation undermines the efficacy of the stress tests. He believes it will make it easier for other companies to tailor their balance sheets to Fed methodologies, gaming the system. I wonder, can the remaining panelists explain why companies won't improperly game the system? For example, if the Fed believes in its stress test model and that passing banks are safe and sound, why shouldn't there be transparency? I'd ask the other three if you have a response.
I think the reforms improve the ability of the stress tests to work. I do think that it needs to be supplemented with these leverage ratios or with a combination of the risk-weighted capital requirements. And in fact, the more I think about these issues as such you're raising, too big to fail, her resolution, Title II of Dodd-Frank, Chapter 14, the more I realize that a simpler way would be just get these capital requirements at a more satisfactory level.
So let me parse out where I think I very much agree with the question and then maybe where I have some concerns. And so where I very much agree is our system is very pro-cyclical, in my opinion. I think we let booms get out of control, and I think during the bust we clamp down too hard. And end up, I think our current regulatory system ends up being, again, exasperating the swings. That needs to be addressed. I don't necessarily think the biggest problem in that is the stress tests. As I mentioned earlier, I'm very skeptical of the stress tests. I would abandon them altogether, quite frankly. I don't think they're very informative, in my opinion. And again, I don't actually think they're very stressful. So that point is, again, I would just drop the stress tests altogether and focus on simpler, more transparent ratios like the leverage ratio.
Ms. Peirce, quick thought?
You could enhance the credibility of the stress tests by making them more open so people knew what the models were, what the assumptions were, and then people could comment on whether they thought those were strong enough or not. I mean, we saw in Europe that people didn't believe the stress tests were very credible there, and so you could have stronger ones. But I also worry that the banks are spending so much time worrying about what assumptions, what data the Fed is using in its models, that they're not worrying about the real business realities that they're facing as a bank. And if we don't believe that bankers can manage their own banks without the Fed walking them through it, I think we're in a really bad place, and that's we can't rely on regulators to run our banks.
I just have about 30 seconds left. I want to talk quickly about cost-benefit analysis on all regulation that I believe is necessary. Wonder, Dr. Taylor, does the Fed's independence require that the Fed be exempt from a review of its rules by the courts? Does Fed independence in setting monetary policy mean that the Fed's financial regulations are above the law?
I think cost-benefit analysis applied to the regulatory doesn't sacrifice the Fed's independence. Other agencies do that. I think it makes sense.
Thank you very much. My time has expired. I yield back, Mr. Chairman.
Time of the gentleman has expired. There are no other members in the queue. Thus, I'd like to thank each one of our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.